Precedents this week. President Biden warning Republicans of the risks of a potential government shutdown with the deadline now less than a week away. Republicans made little progress over the weekend on a short-term spending measure that would still need to pass through the Democrat-led Senate. It seems like it's increasingly likely there will be a shutdown. Unclear, though, Tom, whether the length will really justify its ranking among the quintuple threats that are facing markets right now.
Well, it's going to see. To me, the big thing is his story, as Anne-Marie Horton said. He goes to Michigan, and after those polls that we saw this weekend, it's sort of a near-term, let's jumpstart this, but he's been trying to do that all through the summer. I mean, this is not a new project.
I love what Holger Schmieding said. It's like, relative to the U.S. right now, Europe seems like it's a well-oiled machine. Meanwhile, Morgan Stanley's Ellen Zentner saying it's highly unlikely the Fed hikes rates in November. They think that they're done, Morgan Stanley. Instead, believing the Fed is done and expecting rate cuts to start in March of next year. Zentner tells the What Goes Up podcast, quote, they've got until the end of the year to decide if they're going to hike further, and they've left the door open to hike further if needed. I have a strong view that they're done here, but they have left the door open, basically talking about how the bar is incredibly high, given that their baseline expectation is for a reacceleration slightly of inflation by year end.
And this is really important because you dovetail Zentner's economics, Lisa, with what we see with Jim Caron a few days ago, applying it into the bond space. And this is the Morgan Stanley bet that this is it, price up, yield down at some point.
There isn't conviction right now. This is very much controversial and very much non-consensus, if you think about it, because as Katie said, and I keep going back to this, everyone says they're buying bonds, but they're selling. And if you believe Ellen Zentner, you'd be a bond bull. Excuse me, I'll get it out.
Nailed
it's
that.
Incredible.
Sound like Tom Keene.
Thanks. This to me is going to be really interesting, whether people start to lean into that.
Well, we'll have to see. Everybody's going to have to rewrite this. Everybody's got to do their Q4 guesstimates on outlooks. I think it's as foggy as it was. What else do we have here?
Delivery times for Apple's latest iPhone, the iPhone 15, which I know you're very excited about. I think that Fat Bill's going to get one too. Well, the lines to wait for Apple's cheapest iPhone 15 model are almost twice as long this year than its predecessor, signaling strong demand for the company's newest phone. Buyers waiting 10 days to receive the basic model, up from 6 a year ago. Pre-orders for the iPhone 15 Pro Max increased to a record. Significant upgrades to both models are what some people say are driving demand. What I find interesting is this is even in China. It's not just in the U.S. And you wonder if maybe all of the regulations and the pushbacks of the Chinese authorities didn't really have the effect on people in the rank and file in China, the consumer, in terms of pushing them away from the iPhone.
Thanks for the email. Thanks for watching and listening in London, and particularly in Covent Garden. We just had a Faro sighting, WC2E 8HB. That's a zip code in London, and that's like the Apple Store, I think, sort of in Covent Garden. He's down there picking up a new toy. This is hugely anticipated, and this is what Bloomberg surveillance is about. Our team is 24/7, and over the weekend we said, get Catherine Kaminsky on the equity markets and get Earl Davis, head of fixed income at BMO Asset Management, on yield as well. Earl Davis joins us to bounce off what Catherine Kaminsky just said. Earl, you say price down, yield up. You have a greater conviction on that than the last time we talked.
So here's the interesting thing. The answer is definitely yes. This is unfolding largely as we saw it, and we still see, significant room for a sell-off on 10 to 30-year bonds, possibly 50 to 75 basis points higher before the end of the year on 10 to 30-year bonds. Having said that, we do see that as a buying opportunity. Friday we actually reduced our short position slightly, not by buying nominal bonds, interestingly, by buying tips. We do see tremendous value in the tip market at a 2.20 real yield. Not to say it can't get cheaper, which we believe it will, but that's where we're looking to buy when we're reducing our short position.
Well, two questions, one very short. Where does the 10-year real yield, where can that frame out from a 2.20? Does that have scope and scale, teens, weens out to 2.22, 2.25, or can it really jump out?
It could really jump out to 2.50 to 3%. It was at 3% in 2008. And let me explain the reason why. When the real yields goes up, investors obviously get a real return. And with the economy being so resilient and still being strong, you know, solid, as the Fed said, what they have to do is take dollars out of the growth economy, put it in the savings economy, and you do that by having a higher real rate to attract more buyers. So we can see it going above 250. We think possibly 3%, very top end.
I'll stop the show here, folks. This is so important. You've got Katie Kaminsky and Earl Davis pushing against the broad consensus, looking for lower price, higher yield. This is a global Wall Street issue right now. Earl Davis, that comes down to the gamma that we see, this instability, the velocity, the convexity almost that we see in equities. If we get a Davis bond pricing, do things unravel? Do we get to an instability? Do we get to greater gamma?
So the answer is yes, but for a very short period. We believe 2024, the economy will still do all right. So we do like credit, we do like risk assets, not at these valuations. So we do believe we unravel because you have to reprice for the higher discount rate. Once it does unravel, we will be buying. We will be going overweight. And I think that's something important to note, that, you know, these are the flows and ebbs of the market, and it presents itself with opportunity. That's why, you know what, we're active managers, and that's what we believe active managers should do.
Earl, you were saying that real yields go to 2.5 to 3%. Is that correct? Real yields
that is correct.
on a 10-year
A
treasury.
high probability. Nothing's for sure.
But to me, this is the lead of this whole thing, because a lot of people are saying this is not driven by inflation. It's not driven by growth. It's driven by something else. What is that something else driving the real yield higher?
Well, I'll tell you what it is. It's expectations. You know, when you read history books and the 70s and inflation, throughout the 60s, 70s, inflation wasn't an annoyance. It wasn't public enemy number one. It wasn't until Reagan and Volcker came in where they said inflation's public enemy number one. We're going to cut it, we're going to get it down. Right now, we're still in the annoyance phase of inflation. That's why we think it will persist. That's why we think this is a secular change towards high yields, because it takes a lot to get it to be public enemy number one, and we're not quite there yet.
At this point, you said that you're going to be a buyer when there is some sort of unraveling. What kind of unraveling is going to cause you to be a buyer if everybody's been saying this? They're waiting for the dip to buy, and that's the reason why there hasn't been the dip.
Yeah, you know what? The way we take risk is a mix of quantitative and qualitative. You know, we have structural risk and tactical risk. Our structural risk will be buying as yields get higher. We have our levels, we have our view, and then we reassess as they get to those levels. But as I said, we're still short, and we're still fairly significantly short, but we will be covering that on any further weakness and ultimately going long.
How concerned are you about the quintuple risk that we keep talking about, that maybe we're seeing right now, capitulation ahead of the market turning toward all of the expectations of slower growth, given shutdown, strikes, higher gas prices, student loan repayments, and just the rates, the cost of borrowing going up as much as it has?
Hey, listen, I don't have any concern. And the reason is, I look at the market, it's all about framing and how you look at the market. So I look at the market like a Boeing airplane. So we're getting all these weather patterns hitting each other, low inflation, high growth, low growth, all this, and we're getting turbulence. And you know what? The turbulence could shake the plane. It could drop 500 feet, but it's going to survive coming out of it. So I have absolutely no worries about it, but I do believe we're going to have a lot of turbulence over the next year.
Earl, very quickly here, and folks, we're going to get a little nerdy here as we did with Katie Kaminsky. Excuse me, Earl Davis, I've got Loonie at a 134. It is stochastic weak Canadian dollar at a 140. It's stochastic because the system's overcome by events. If I get an Earl Davis market, I get a stronger dollar. And does the stronger dollar itself solve its own problem?
That is a great question, and I agree with the sequencing of that. What the stronger dollar itself does, it allows us to play out into our story where there's going to be some volatility in this quarter, but 2024 is going to be all right economically. And the key to that stability from an economic perspective is a stable, strong dollar. So I think it allows us to play into the story of, yes, we're going to have volatile times, but we're on the best of airplanes, and it's made for this, and we'll be able to survive, and not only survive, thrive. You have to remember, as the yields go higher, that's a longer expected return for retirees, for pensioners, for investors in bonds. There's going to be tremendous opportunity here.
Right.
And even though we believe we're in a secular bear market, I see 2024 being a cyclical bull for yields.
This is fabulous. Earl Davis, thank you so much with BMO Asset Management. Folks, this is what this show's about. To have Katie Kaminsky and Earl Davis back to back, both screaming about lower price, higher yield in the fixed income space is what a Monday morning is like. Don Cass emails in the day the liquidity died. Let's talk about that.
He's really building on the theme.
The VIX 18, Standard & Poor's 500 down 0.2%.
Right now, we're looking coming up at a number of different events. You talk about the dollar, and you were talking about the yen and the weaker yen. And what I find interesting is that the Bank of Japan Governor Kazuo Ueda doubled down on his more stimulus-needed message overnight. And that's kind of what some people are saying is driving the latest leg weaker for the yen, 148.63. They're not backing away.
Well, you nailed this because rounded up at 149, and I don't know where they're, it unravels for them, but this is one of the issues that gets you away from the calm in that we're a liquid or we're a solvent system. And Don Cass down in Florida, you should hear Don Cass play American Pie. It's just unbelievable.
After throwing back a couple, it's pretty wild.
It's just amazing. He was at Kidder Peabody years ago. I remember him singing Vincent, Starry, Starry Night. Don Cass did that so well. Anyways, the day the liquidity, he was a kidder, and he used to bring his guitar to events. The day the liquidity died is what this is about. No one's expecting the liquidity to die. We have a soft landing. We have a system here. No one's looking for this solvency liquidity debate out there, given price move.
No one is thinking we're going to get a credit crisis. That has shifted off the table. Some people said that what happened was sort of a stress test back in March with some of the smaller banks and the banking failures, and it didn't lead to anything. So what will? And that seems to be off the table. My answer is Bramo nailed it. We're looking at foreign exchange. There's not a chief U.S. economist in America that does foreign exchange as tightly as Laura Rahm. We'll talk to her in a moment here. We've got that yen out rounded up a 149 level. I've got renminbi through to a 7.31 this morning. Even Turkish lira. Let's go idiosyncratic. Lira 27.2. Where else are you going to get a lira quote on a Monday? Bloomberg surveillance, radio, television.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He taught himself, self-made day trader. Yeah. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
In many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
The lack of reciprocity and level playing field from China, coupled with wider geopolitical shifts, have forced Europe to become more assertive. We stand at a crossroads. We can choose a path towards mutually beneficial relations, or we can choose a path that slowly moves us apart, where the shared benefits we enjoyed in recent decades weaken and fade.
Mr. Dombrovskis, I've really grown to listen to the guy and like the guy a lot. He has been a public servant of the Baltic states and all the Baltic states and also Europe as well. He's European Commission Executive VP and Trade Commissioner. He just works tirelessly. I'll get it out on a Monday.
It's all right. No, it's true. And I think that this is a really different tone that we've heard over this time. And I keep going back to Holger Schmieding, where he was saying that, the European region may be willing to take some pain to really execute some sort of greater de-risking or decoupling, whatever you want to call it, with China.
Good morning across America, on radio, on television. Futures at -10, Dow futures -60. Brammo and me holding court here in London. Eventful trip back. Thank you to all in London for a wonderful week. Farrell on assignment after his Daniel Levy-Tottenham interview caused a firestorm. His media people said, you can't leave now, he's got such a role going that he's on assignment in London, also looking at 3,000 square feet west of Mayfair, I believe, this morning. Right now, we're going to digress to the delicacies that America faces in a fractured Europe, and that fractures mostly around a new Germany, around a Europe, around Germany, and of course, all that's going on with the war in Ukraine and the war with China. Bloomberg's Maria Tadeo briefs this morning in charge of all of our European coverage. Maria, we got here in a Europe after Merkel. As Dombrovskis speaks, as all the others blather in Brussels as you deal with daily, it's a changed Germany after Merkel, isn't it?
It's a change Germany too, but I'm happy you mentioned Dombrovskis, because for an international audience, you need to understand that this is someone who really knows how the European Commission operates. He's not the most animated. Some would say he's a little bit dry, but this is a man who really gets the numbers and really gets the details. So obviously when he speaks, people do pay attention. And the tone in that speech, when I heard that you wanted to talk about the speech, I was very happy, because this speech, it really is quite something. I mean, you have to look at what he says. Essentially, this is a crossroads for the relationship between the European Union and China. And he talks about either we fix it or prepare to lose investment.
Well, okay, but Maria, the cutting edge to me, and this is over the weekend, folks, a lot of really smart coverage of the South China Sea and the expansion of America's military might in a new way in the Trans-Pacific. That's not a European discussion. Maria, is it just an economic discussion? Is Europe dealing in a trade vacuum versus the United States?
No, it is totally economic at this point. And the number, again, the figure that really gets Europeans has to do with the trade deficit between the European Union and China. And Tom, it is growing almost every year. It's almost now 400 billion euros. And that is a number that really underpins this entire tone, this changing tone, really, in a very big way, if you read between the lines, between the European Union. I mean, when you get the guy who handles a trade portfolio that goes to China for 4 days and say, we have to fix the situation, otherwise the European Union may not be as keen in investing and opening the market to China as we have been, that is a very significant change in tone. And again, it all goes back to that number. The Europeans are not happy with that trade deficit. The question is, of course, what happens with Germany? This is a country that has been the most reluctant. They have been fearful at times about potential retaliation. But also, Tom, you pick up a lot of different sentiment now in this condition and in this commission that says the fact that we listened to Germany for so long, that we were so fearful of China, has prevented action that was valid and legitimate.
And this is what we heard from Holger Schmieding, that suddenly there's a willingness to take pain in the near term to de-risk, his word, decouple maybe somebody else's word with the Chinese economy. How much pushback is there right now from Germany?
Look, for the time being, not a lot. And remember, they actually agreed to that EV probe. We should note it wasn't Germany that pushed for that probe. It was Emmanuel Macron of France that wanted this probe into the electric vehicle, because he does believe it is the future of the sector. But again, beyond that, for the commission, what they say now, you should note also that the head of the commission is a German too, and she's willing to open this probe. I think what happens now is that the Europeans have to some extent realized that trade is great, but the European single market, and this is a moneymaker for Europe, may have been abused a number of times. And when they look at China, they take the experience of the solar panels. You know, Europe had the technology, but they got wiped out by Chinese companies. I think there's been a realization of that, and the political mood is changing. I'm not sure how much Germany will be willing to run with it, but for the time being in Brussels, it really has. And this is a relationship that honestly in the past 2 years has gone very cold.
Which is a question about whether this is an alliance with the U.S. or whether this is Europe kind of in its own right trying to make a move for long-term prosperity. How much is this being driven in tandem with other nations in the West versus a kind of go-it-alone, very European bespoke agreement that they're trying to reach with China?
Well, in terms of, we all know that both in the United States and the European Union, everyone says no to decouple, that is too late, that train left the station already, but yes to de-risk. And so the language on both sides of the Atlantic is identical. But when it comes to this push from the European Union, I would say it is very European. You know, I think when you look at the single market, we should really stress this. The Europeans view this as their crown jewel. This is the moneymaker. They have to protect it. And as you see now, they're willing to not just protect it with actions, but really a speech and a tone that is very different when it comes to China. Again, for Valdis Dombrovskis to go to China and say, we're at a crossroads. You either balance this relationship, we narrow that trade deficit, or prepare to lose investment. That is very significant. I mean, to me, the speech, it really is very important.
How much meat is there behind this, though? How much willingness is there to actually levy tariffs or engage in some sort of de-investment, even potentially at a loss?
Look, I think when it comes to the trade war, the European Union has been clear that they do not want to see a trade war, and they also believe that a lot of the trade that goes from the European Union to China is actually beneficial for the European Union. Everyone is clear on that. The reality is, when you look at, however, the number that has triggered, maybe not alarms, but really concerns, is the fact that you see this trade deficit in favor of China constantly, consistently, every year, and it's growing, and no administration has been able to narrow that. Then when you look at that speech, what Dombrovskis gets to is, we don't want a trade war, but we need to narrow that trade deficit. It's 400 billion euros. It's enormous.
Maria, thank you so much for the brief. From Europe there, and something that seems distant, but all of a sudden it mixes in with American-Chinese policy as well. Maria today in Brussels on the stridency of trade in Europe as they look to China as well. You know, you miss, at least I'm sorry, you're 1 week in London, we're out of touch. You know, don't you lose it? I think in any number of ways. I was looking at like how are the Giants doing? They're terrible. And the Jets, they had that terrible injury. And Aaron Rodgers, the Padres, I think they won 9 in a row. Tatis with a great catch. None of it matters. None of what we do matters, folks. Even Michael Purvis coming up with Tallbacken. Because there's only one topic this morning.
What's that, Tom?
Here's a partial score. The Bears beat the Chiefs. No one cares. They don't care what we're doing as well. Taylor made an appearance. And this is, I can't even begin to explain the politics of Miss Swift at Arrowhead Stadium to her right, off her right shoulder, on radio, dressed in the garb of the receiver for the Kansas City Chiefs, Travis. Travis's brother Jason plays for the Philadelphia Eagles.
Okay, I'm curious, Tom.
Taylor's an Eagles fan, but she's wearing Chiefs red.
Okay, so I knew you were going to go here. Taylor Swift is evidently having a romance with the Chiefs tight end.
Unconfirmed, but we'll go there.
Travis Kelce. And Kelsey. Yeah, I'm nailing it. Even though she is an Eagles fan, and that is the news,
huge.
right?
This is like bigger than Biden.
How do you catch up after you've been off for a week with what you need to know that happened in the U.S.?
I go to the Afterthought. It's my load of American gossip. I do two things. I go to Afterthought and get a briefing. And there's a tradition really back over 15 years. I go to Scarlet Fu, and Scarlet Fu is the surveillance celebrity lodestone, and she gives me a brief.
Okay, so then she tells you.
She knew the strike was over with the screenwriters before the screenwriters.
Because there was a romance between the Screenwriters Guild.
I said, what's Oppenheimer doing? And she said, it's great. And Barbie's doing something in Russia, and, that's breaking up. But, this Taylor Swift thing is really big. You make light of this.
I'm not making light of it. I mean, it's really important. Wait, why is it the most seminal news item that you need to
Well, they had a Super Bowl, and Mrs. Kelce, Travis's mom, had to choose between Philadelphia and Kansas City.
Did you see that Usher's going to headline the next Super Bowl?
I saw that. Actually, this is really cool.
I said to my son, did you hear this? And my son said to me, who's Usher? And that's actually a key question, because for a lot of the younger kids, they don't know the artist.
First week at Bloomberg, Matt Winkler, founder of Bloomberg, got approval from Reto Gregori. They put me up at the Ritz. I'm going down the elevator with this kid with diamond earrings in his ears. It was Usher. I was the only one on the elevator who didn't know who Usher was. Usher, the Super Bowl.
There you go.
This is Bloomberg. Good morning. S&P.
Venture capital. It's been volatile. From bank crisis anxiety to AI exuberance, Caroline Hyde and Ed Ludlow chat with the biggest names about the latest tech trends.
Is AI going to dominate the earnings narrative for this sector this week?
I think we're seeing opportunity and potential platform shift that we haven't seen in a long time.
If you're a company today and you're not embracing the changes that are taking place with AI, you're going to be behind.
How do you prove to the investor base that you haven't just tacked on AI to make yourself sexy?
It's very hard to differentiate if you're not experienced with AI.
The startup stories.
We think this is a watershed moment for technology.
Certain categories are more exciting than others. Right now, obviously, generative AI is a category that is very exciting to startup founders, customers, and venture capitalists as well.
So what we are seeing is a new area of opportunities for new founders to come and change the industries that matter.
And the real talk on realistic valuations.
Some of the best opportunities are sitting right in front of us.
How do you discern which ones are good on the marketplace right now?
I think founders have woken up to the reality that taking on more money at higher terms doesn't necessarily play to their benefit in the long run.
How do you actually invest?
Follow the VC money on Bloomberg Technology, the only daily business show dedicated to tech right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television. From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
So what's the best investment advice you've ever been given by anybody?
The compound interest, the compounding of returns is an incredible miracle of business, finance, and human existence. Everything you learn is additive every day, and if you keep at it and don't quit, it's an incredible miracle. And it's not just interest. It was always said about compound interest returns, compound business returns, compound human returns. They're all very additive because you learn every day. And if you keep at it, it's very, very helpful.
In your observation of investors, what do you think is the biggest mistake that average investors make?
Selling at the wrong time.
And they sell when the prices go down?
Yes. Or yes. Not keeping, look, people have conviction or they invest for if they invest for the right reasons, just keep at it.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is gonna be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
We've seen phenomenal sort of narrowness in the US market.
It's really hard for the market to look for a dovish Fed right now.
The markets are going to have to accept that they really are willing to keep interest rates higher for longer.
Our concern is that they are going to keep rates too high for too long. They're going to slow down growth too much.
At some point, their lags are going to come in.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
The quinfecta of threats heading into Halloween, the toxic brew of different issues. Good morning. This is Bloomberg Surveillance on Bloomberg Radio and Bloomberg Television. Tom Keene, Jonathan Farrow, and Lisa Abramowitz. John is off today doing some really cool stuff, which we will bring to you later. And it is us back in New York. And I have to say, it feels different, Tom.
Yeah, it's absolutely different here. There's a real change going on, and the news flow is absolutely extraordinary. And what we've really focused on through the hour in the economics, financial, investment markets is price down, yield up if we were to see that. Nobody, excuse me, did I get that right? Yeah, price down, yield up. Got it.
Doing great.
And nobody's pricing that in
right now. We remember month after month, the yields would go up, especially on the long end, and you'd have all the bond bulls come out, and they would say it's time to buy. And this time feels different. Suddenly, all of the bond bears are lining up to say this is just, the new normal, and that feels like a different set of parameters at a time where people are thinking maybe the economy can withstand it, maybe it can't, especially with some of the other risks, the strikes, what we're seeing with gas prices, what we're seeing with the government shutdown.
Lisa's going to do the data check here, but you got a deterioration of the tape right now with the VIX over 18 solid, the 18.03. With Michael Purvis coming up, I think it's a perfect segue from what we did with Katie Kaminsky and with Earl Davis. What I would say, Lisa, is it's a compendium of this day, this day, this day. It's adding up. And to the gloom crew, you wonder when it breaks. That's sort of the tension that we have Monday morning.
Two things. To me, I'm focused on what's going on in Detroit. The fact that we're going to have President Biden there tomorrow. We're going to have the former President Trump on Wednesday trying to rally the troops, and then later in the week we get retail sales as well as core PCE. And to me, that in tandem with earnings from the likes of Nike, H&M, Costco. Do consumers keep spending at a time where yields are climbing to the highest levels going back to before the financial crisis? To take a look at what we're really watching today, it is the real yield. And that to me, and what you're talking about, yields higher, you can see the real yield going to the highest levels going back to 2009. You can see gas prices climbing, yet again, reversing as hedge funds get bullish to the greatest degree since 2020.
For those who are not in the game, you're not part of Global Wall Street, we thank you for watching and listening every day. 2.11 on the 10-year inflation-adjusted yield permeates through the system. I can't emphasize enough how the effect here of taking us back to, I believe you said, Lisa, 2009, or to take some of these levels like the mortgage rate, 7.75%, 2 days ago, I believe it was. It takes us back to another time and place. A lot of people haven't been there.
And there's a foreign exchange component to this as well, which is strong dollar, which is getting to a level that a lot of people think is disruptive. We heard that last week from a number of different guests in London. The euro hovering near its weakest going back to March. You could see the dollar ascendant. But with the yen weakening to such a great degree, and Ueda, Governor Ueda, not backing down. Again, these different features that just paint a less stable backdrop with very new contours.
I know you're going to want to go through the data check and get Michael in here, but to me, the basic idea, folks, is you can warble gaily about equities, bonds, currencies, commodities, but you never know what's going to be the catalyst to break.
Right.
I mean, I'm not saying it's the real yield. It could be, it won't be something dramatic like Argentinian peso, but as talking to Looney with Earl Davis, it could be Looney going out to 135, 136. You just don't know.
We're seeing weakness, and what really comes after a particular weakness in the Magnificent Seven. We're seeing S&P futures down 0.3%. NASDAQ continuing to underperform, and that to me is interesting at a moment where it had been the stalwart. Meanwhile, you do see a bit of dollar strength, 106.32, still firmly below 107 for the euro, and that 10-year yield crossing the 4.5% threshold. Wow. So just continuing to climb higher to some of the post-crisis highs.
And moments ago, perfect timing, Bridgewater of Connecticut, it's a startup shop up in Connecticut outside New York City. Bridgewater says, quote, Japan's move away from negative rates now looks overdue, and that's some of that tension of yen at 149.
Joining us, Michael Purvis, founder and CEO of Talbot and Capital Advisors, to put together how different this landscape really feels. Michael, from your perspective, do you think that yields can continue to climb from here, or is this a topping out as people finally capitulate?
Look, I think, take the 10-year nominal yield. I think there's sort of a big technical air pocket to 4.75 and then 5% here. If you look at technicals on the 10-year yield, those are looking like Bitcoin did a couple of years back, right? It just looks like it's going higher here. But I think, when you think about some of the fundamental underpinnings of it, you've got a situation where term premia, you can measure it a couple of different ways, but that has been expanding. You were just talking about Japan and the BOJ. You're looking at interest rates around the world shifting higher. That means the foreign anchor of Japanese or, say, German sovereign paper is not what it used to be. It was just a couple of years ago we had, 18 or $19 trillion in negative yielding debt. That's down to $500 billion today, and it looks like that $500 billion is heading to zero pretty fast. there. So I think this is a Treasury sell-off very different from last year's Treasury sell-off. Last year was about, how many hikes is Powell going to give us? What is CPI going to do? This year, it's much more about really, I think, roping through where our star is going to be, where Fed policy is going to be over the longer run. So I think the 10-year is going to keep shifting higher here.
Just to double down quickly on what Tom just mentioned with Bridgewater, are you saying that Bank of Japan is sort of inevitably going to also back away, that they're the next stone to kind of drop in the steady march toward higher benchmark rates?
Look, I think right now the BOJ is playing with fire a little bit with a currency, with a country that imports all its oil. Right now, it's a stretch to call the dollar a petrocurrency, but relative to Japan and frankly Europe, we kind of are, because we're not an importer of oil like we used to be, and oil extraction is a big part of our economy. We're now producing as much as we ever have in the United States' history. Japan, of course, doesn't have that ability. So if the dollar rallies and say crude jumps another $10, $15, $20, you're going to start looking at the yen at a very difficult place, which means either the BOJ has to join the hawking party, if you will, or you're going to see some really, really interesting and potentially dangerous dynamics play out in a very important economy. And that could be one of the tail risks that all the markets are going to have to contend with in the coming months if the BOJ continues to play this game.
Michael, what do you do if you get a correction? It's been so long since we've had one. I take immense issue. I take immense issue with where we are now, the gloom and all that as well. I look, Michael, we've got the SPX down 5%, Dow down a little bit more, NASDAQ down 7%. I'm going to call it a summertime drawdown. That's not a correction. Can you see a correction coming? Can you plan for it?
Well, I'd say it this way, Tom. I think there's parts of the market that have been very overextended. That's the Magnificent Seven, the big tech part of the market. I think if I'm right that nominal real longer-term interest rates are going to settle into a higher floor than what they had been, then I think those valuations are going to come down unless they, if they blow out earnings, in the next quarter. That's now not too far away, okay, you can maybe still have some AI buzz hitting those things. But I think what I'm expecting to happen is that valuation will adjust lower on the big tech part of the market, and the call it the everything else part of the market will be okay because the valuation is not overextended there. With all that said, I'm kind of looking more of a range-bound S&P into the rest of the year and frankly into 2024, because the earnings growth in 2024 is probably, in my estimations, going to be mid-single digits.
On dollar call, DXY, if it was to break out higher, we talked about the Plaza Accord earlier. Let's not do that now. But Michael Purvis, the basic idea here is dollar strength becomes pointy, becomes stochastic because people say no. Are the institutional forces in place that if we do get a renewed dollar strength, it can reverse rapidly?
Look, I think, there's sort of there's a couple of different types of dollar strengths. One is from a risk-off shock because something bad happens in the world and the dollar gets bid in sort of a reactionary form. I think what's happening here is that because real interest rates and nominal interest rates in the United States are just heading in a higher place than they are relative to Europe or Japan, the two other most important economies and currencies, you're looking at a situation where the dollar looks like it's going to have this sort of structural support here that's more gradual. It's not a shock type of dollar rally. It's more of a keep the dollar stronger, longer, if you will. And that's reinforced by, if oil continues to stay in these higher levels, I think it's going to, keep reinforcing that. We don't have the hydrocarbon vulnerability that Japan and Europe have. So I think that's going to be a sort of more of a long-term weight over certain asset classes like EM equities and other, more dollar-sensitive assets.
Just quickly here, Michael, what's your highest conviction right now?
My highest conviction is that I think we're going to start seeing some of the big tech continue to sell off here, just not because there's something bad per se happening, but just simply valuation adjustment against higher longer-term interest rates. So, I went out with NVIDIA puts in early August, and I'm holding on to those.
Michael Purvis, thank you so much. Greatly appreciate it. Michael Purvis with Tallback and Capital years ago. This is a huge, ginormous call on ADXY on the currency dynamics of the Pacific Rim as well. The tape deteriorates. I'm not going to make a big deal about it, but the tape deteriorates. Lisa, futures negative 11. The VIX out to 18.07. I got a 0.3% move on NASDAQ. And to me, it's like the way it's deteriorating, it's just giving, the bid's just giving away here is how I'd frame that.
To me, it feels like suddenly real rates are very much in the focus, and there's a question about how much further valuations can continue to richen if you have this kind of rate backdrop.
Well, you get into first, inventories, last in, first out, and all that. You got the retail people coming up. It affects them just like it affects the banks coming up. J.P. Morgan, October 13th. A lot going on here. To say the least. Standard & Poor's 500 down 0.3%.
In the backdrop of all of this, Tom, there's a question about going back to the office. Did you see the story in the Journal over the weekend about people counting badges in and out to determine how often people are in the office? And it did. They did some surveys of office attendance requirements. About 1 in 5 require 5 days a week back in the office.
Yeah, well, it's an important thing. There's like 21,000 people here at Bloomberg making the terminal go every morning, all the different things that we do. And I'm the only one who doesn't have a badge. I mean, I don't badge in. They inserted a chip.
Oh, is that right?
Yeah, right here. They put a chip in right here.
So you badge in
a little bit lower.
You have to badge in for Mrs.
It's like the dogs have
She
the
requires
security
it.
thing in case they get stolen, kennel fee and vet building. Mike put a chip in right here. So I don't have a badge.
That's great. You just sort of beep every time you walk in. They sort of jump in. Exactly. Sort of shock you.
Electric shock. It works out.
There is this question about when this is actually going to bring some sort of reduction in vacancies. And you're seeing that on the margins in certain places, but not really. I mean, you were saying it feels like it still is just about.
Yeah, it's there, and I think the interviews today have been, the conversations, I should say, have been really, really good here. Terry Haynes coming up. But the heart of the matter to me is when in doubt, you follow the deepest, broadest market. And even if you're not part of Global Wall Street, folks, on radio, on television, get up to speed on your choices of foreign exchange. Terry Haynes doesn't know anything about foreign exchange. That's why we're having him on.
Great.
There's going to be a shutdown. They're going to stop printing dollars there on that road from Reagan into the United States. Treasury's going to... Terry Haynes is so august. His name was on the dollar once. He signed it, and all that. Coming up on Washington on your shutdown across America on a president. At the picket lines, Terry Haynes, Pangina policy. We'll do that next. Futures deteriorate, negative 11. Good morning.
London, in Sydney,
from Washington,
in Tokyo,
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
How do you compare the pleasure of being Secretary of State, Senator, First Lady with being a grandmother?
Well, actually, there are similarities. Negotiating with 3-year-olds is about as hard as anything I did as Secretary of State.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
proud of being the most pro-union, pro-worker president, not only compared to the Trump administration with its anti-union policies, but really compared to any modern president. These auto companies can thrive in a win-win deal that does what the president has called for, which is to say that record profits should lead to record pay and record benefits for the workers who are creating all that value.
On CNN, Peter Buttigieg, the U.S. Secretary of Transportation there, talking up where we are. I had a 3.5-hour plane delay. We circled over White River Junction for 40 minutes. I sat on the runway at Newark at 20 minutes, and then I called the Secretary of Transportation.
Oh, is that right? What'd they say?
I said, what do we do?
We'll go staff
It was
the
sport
air
coming
control power.
You come over and you wave at Iceland and you slide into Middletown in the Gulf Stream, and it's a different world after all. Right now, futures -11. The tape is deteriorating on this Monday morning. Not sure what to make of it. Curve disinversion. 2's10 spread out to 62 basis points. It was much more inverted weeks ago. My headline is I got a 2.11% on an inflation-adjusted yield. Lisa, what gets you in the data? Is it the yen and dollar dynamics, stronger dollar?
The fact that 10-year yields have crossed over the 4.5% mark, once again, that it's being driven by real yields, to me colors the entire discussion, which is we are seeing real yields dominate, taking a little bit of the froth off the top. And to me, that's the real question at a time where there's a political brew underpinning this with strikes, shutdowns, higher borrowings, et cetera, at a time of, otherwise strength and resilience. But for how long? That's sort of the question.
I was distracted in London, and I did not notice that I believe Thursday last, 7.75% on a 30-year mortgage. I missed that. And it wants up.
Look, I've read so many notes about how the mortgage market, the housing market's broken, right? Essentially, nobody wants to buy an existing home because no one wants to pay that, right? So at what point do you get the price corrections if you get a functioning market? How does the Fed deal with this? I mean, it seems like they're not that concerned.
Right now, we're going to dive into the toxic brew of our politics. Look for balance of power this evening. Amory Horton, Joe Matthew, Kaylee Lyons helping out from time to time there. It is just fascinating on shutdown, on strikes, and the rest in Washington. Terry Haynes is a student of this. He's founder of Pangea Policy. Always speaking to Terry Haynes is win-win. So we're going to win-win here in a lose-lose for the president. Terry, I'm going to cut to the chase. How does President Biden break the lose-lose moment?
Frankly, Tom, I'm not sure he can. The president is now in a situation where he's constantly having to shore up his base, and in order to do that, since the base are kind of small but powerful within the Democratic Party constituencies, teachers unions, the UAW, that sort of the Green Lobby, those sorts of people. It makes it much harder for him to go to the center, and you see that kind of cul-de-sac in the recent numbers you and I were talking about on the break, where his approval rating is at best a low 40%, but nobody's giving him good marks on the economy. He is either even or loses to Trump. He certainly loses to Nikki Haley. All these sorts of things, and plus there's now a rising third-party candidacy risk too.
I got 8 ways to go here, Terry, in the time we've got. The stew is so rich right now. And let me try the government shutdown. We've spoken to people this morning who look at the government shutdown as an 8-day dalliance. That just seems too cavalier to me. What is the gravity, the reality, the gravity of a shutdown?
What I've been telling markets for quite some time is, first, the shutdown's likely. Secondly, and I think really importantly this week, markets need to understand this is not the same old one and done that they've been used to that doesn't really have any economic impact. This is going to go on for about 3 months. The reason why it's going to go on for about 3 months is with stop-starts. Sometimes the government will be funded, sometimes it won't. Is that they haven't? You've got Biden kind of in the tank on his own numbers. You've got a Congress that bipartisan, bicameral, that's lazy. These people took 7 weeks off instead of dealing with this, and now here we are. So this crisis is by and large self-created, but they haven't done any work on appropriations bills, which they need to do. They haven't finished anything. It'll take them the next 3 months in order to finish the defense authorization and the defense spending bills, that by which time the rest of the appropes catch up and they can actually do something before Christmas. Why that's important is that according to the budget deal, a 1% cut goes into effect in January. If no deals are done, nobody wants that. So therefore, that's the 3-month time period. Why that matters for markets is that there will be more volatility in areas that are heavily dependent on government. Defense, does it get funded at what level, who, how? Same with healthcare. So it's a different deal.
Amid all these discussions about cuts to the deficit, is there any discussion about Social Security, about Medicare, about Medicaid, about the major costs that the nation is incurring?
No, not at all. Not even close.
So what does that say to you in terms of the
theater? There's no political will or courage to do that. I'm sorry, Lisa.
So no, but Terry, I mean, what does that say to you about how much this is theater and how much this is ideology and how much this is sort of a de facto necessity of a shutdown, regardless of any kind of agreements or technical anything?
I increasingly have to restrain myself from saying kabuki theater over and over because it is. This is self-created theater. Anytime you have a bunch of people who claim to be seriously concerned, Democrats, Republicans, House, Senate, whoever, seriously concerned about the direction of the country, and want their policy priorities put in place, and yet for 7 weeks don't do anything about it, that will tell you everything you need to know about the seriousness of those people and their desire to actually get something fundamental done.
Who is this kabuki theater for, and is it working?
It's for the bases of the parties. It's for those who fundraise off of outrage, whether it be on the left or the right. And does it work? It works in the sense that outrage gets a response in righteous anger and more campaign contributions. Does it work in the sense that they're any closer to solving the problems they claim to care about? No, it doesn't.
Terry, I want to go back to brass tacks, which is way out in November, the first Tuesday of November. President Biden won over 80 million votes in the last election. No one's had more votes in an election ever than the loser, Donald Trump. That tells me it's massively about turnout. Can you gauge now in any way, shape, or form the emotion of turnout in October of next year?
My instinct on this is that the outrage turnout is driven by outrage and driven by kind of galvanized on issues. My sense is that those who are outraged on the Republican/right side probably have more energy than the folks that are outraged on the left. Not only that, but you point to Biden's vote totals. Massive amount of those overvotes are California and New York, places where it's pretty much just running up the score. It's a world where the president won 4 states by a combined, roughly 100,000 or less, and so that turnout's going to make all the difference. I think the outrage that comes from a lack of movement in Washington just stokes things a little bit more.
Terry Haynes, thank you so much. With Pangea Policy, again, balance of power tonight across Bloomberg Television and Bloomberg Radio. Every once in a while, a headline comes across and you stop. It's a Bramo quality headline, to say the least. There it is, just in Technicolor.
Well, basically, you could see 10-year, 30-year yields both rising to post-crisis highs of the cycle. We were just talking about the 4.5% 10-year Treasury yield. You could see that 30-year yield, 4.6%. These are round numbers. Up less has been the 2-year yield. We have seen a plateauing out, which really highlights that flattening of the curve that Katie Kaminsky was talking about, Tom.
Please stay with us for continued market coverage here. It's not overt yet, it's not demonstrative, but boy, is there a tight correlation across equities, bonds, currencies, commodities. Dollar strength comes up here with a vengeance. The real yield 2.12% again, and I guess, Lisa, more than anything, I've got to go to the currency market. I think you're going to get sterling You know, you're going to get a 121 handle in sterling. Pharaoh's never going to come back.
Dollar strength.
I'm here. I'm in
has
London.
Been the story. Yeah, although he's got to get paid in dollars to really make it work.
Well, that's why he's just living large there, west of Mayfair. Laura Rahm next, perfectly timed. Stay with us.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
I found myself in a spot where I was constantly getting new challenges. A lot of, I think, the best mentorship I had at Bridgewater is because people often saw in me the potential to do things I didn't even see in myself yet.
Bloomberg surveillance on radio and television and market check in order. It's pretty much, Bramall predicted this, to be blunt. We're up a stick on the VIX, 18.19 with tape deterioration. It's not a big deterioration, but there's a weight to the tape this morning that's extraordinary. Futures at negative 13. Again, the VIX 18.19. And Lisa, history being made in the bond market, higher yields.
The idea of 10-year and 30-year treasuries both crossing round numbers, 4.5 on the 10-year, 4.6 on the 30-year. Looking out to some of the highest yields going back to 2011 for the 30-year and well before that, 2006 for the 10-year. At what point do we reach some sort of capitulation, Tom? That to me is sort of the key question.
Yeah.
Are we reaching a point where people are saying this is sustainable, or are people throwing in the towel on being bond bulls, which a lot of people said they've been?
Well, it's going to be interesting to see. And the tandem that we had at Katie Kaminsky and Earl Davis here, Alpha Simplex and BMO Capital Markets, The basic idea that both of them from two different worlds are saying, okay, what happens if we get price down, yield up? Besides an 8% mortgage rate, I think it's a joint study on Monday.
And at what point does some of the froth start to come off the risk asset sphere, right?
Yeah.
This is sort of the interesting other side, is that people are saying maybe we can live here, right? This is okay. This is sustainable. Okay. Well, if that's the case, how much strength does there have to be given the quintuple threat that we've been talking about?
We were jetting back, living lazy, living large, and our team worked through the weekend on market coverage. We'll get to Laura Ram here in a moment. Just a perfect moment to speak to Ms. Ram, Chief U.S. Economist, FS Investments on Foreign Exchange. But first, we have to go to head of our Surveillance Shutdown Central. Michael McKee joins us, Bloomberg International Economics and Shutdown Correspondent this morning. I know it's funny, but it's not. Give us one vignette of the pain that will be inflicted upon this government shutdown.
Oh, there are so many, but I think one easy thing to look at is the number of people who get furloughed who don't have any money coming in. Their kids become eligible for reduced or free meals, but there's no money for the reduced or free meals. So there's be a lot of pain and suffering, especially in lower income levels because of this. It won't be a huge macro issue unless it lasts for a long time, and I'm afraid that Terry Haynes is probably right, that this could go on for months. And if that's the case, then we have some real problems beyond just money.
And we're talking about also the idea of a data-dependent Fed at a time where data might not come at all. What data might we not get if the government shuts down, as most people actually expect as the base case?
Well, the first thing you won't get is construction spending, which is due next Monday. We have the JOLTS report next week, jobless claims, obviously, factory orders, and, of course, September payrolls, the jobs report, which is considered reasonably important to the Fed and their futures. We also wouldn't get the next month's CPI if it continues to go on, because there won't be anybody to collect the data for October.
Take us behind the closed doors, and are there people still collecting the data and just not releasing it, or are they not even collecting the data, really giving us a dark period of data vacuum at a time where data's never been more important?
Well, for some of the numbers, data comes in. The establishment survey is a survey of companies, and they send their data in, but somebody has to collate that. There may be a certain number of people who are brought in to work without pay to put things like that together, but in previous shutdowns, we have not had the government release data. The last one we had, if you remember back that far in 2019, when it was finally ended, we went several months without getting data until they could catch up to everything. So if you're the Fed trying to make policy November 1st or December 13th, you may have a real problem.
In the 142 papers on your desk that amazingly, folks, are red, I should say that, different than me. On the 142 papers on your desk, is there a political tinge to a shutdown? Are Democrats hurt harder than Republicans, or vice versa?
Well, historically, it's been Republicans who've taken the blame, even when there was once a shutdown during the Obama administration, because the Obama administration wouldn't give in.
But what about the public? What about
the public tends to blame Republicans for it. Now, the question is, we're far enough away from an election. If this goes on for a long time and there's some lasting damage, then it might linger. But when you look at the consumer, I've gone back and looked at the consumer sentiment numbers. People don't even notice. It doesn't register. It doesn't show up in consumer sentiment, and then it certainly doesn't show up really in spending.
Surveillance Shutdown Central there, Michael McKee, and he'll be giving us a lot of perspective on this into a potential shutdown. Laura Ram joins right now, Chief U.S. Economist at FS Investments. A timely interview, Lisa, to say the least.
Especially given the fact that we might be heading into a vacuum of information. Laura, you were, I'm sure, listening to Michael McKee talking about what we may not get going into a dark period at a data-dependent Federal Reserve making crucial decisions. How important is that aspect of some sort of shutdown that is underappreciated in markets?
I think it's very important because you still have a real disconnect between what the Fed says they want to do and what markets are expecting. And the only way to really close that gap is for the Fed to really, come in and jawbone markets, and they would ostensibly use the data to do that. If they don't have the data to back it up, and listen, the economy has been very strong. The data has looked really solid, And I think the Fed has absolutely used that as a foundation to try to push markets towards the fact that we both need, maybe another rate hike, but also are not going to be cutting. And all of that is data-based. So to your point, it really makes it hard for them to close the gap between what I think they've signaled to us as policy, like in the dot plots, in the economic projections, and what markets are pricing.
There's real tension right now. A number of guests have come on the show this morning and said that they expect yields to stay here for a longer period of time. This is the new reality, and they think that this economy can continue to keep going regardless of the fact that it is that much more expensive and discretionary income is going to a lot more basic assets around the house. Do you agree with that, or do you think that it's getting to the point where these yields are unsustainable?
So it's a two-part answer, because I don't think that these yields are unsustainable. And in fact, if you look at, I think everybody's now looking at the mid-90s as a guidepost, the one time the Fed was able to raise rates and not cause a recession. The Fed held the Fed funds rate in restrictive territory for 3 years, and long-term interest rates were quite a bit higher than they are today. I think that flattening, this sort of bearish steepening where bonds are sold off across the curve, is probably going to continue. I think there's a huge disconnect, which I think people aren't talking about enough, between equities expecting the economy to be strong and revising earnings estimates up for next year. I mean, right now, consensus earnings estimates are up 10, 15% next year.
Yeah.
If you just look at the broadest base, that is really implies significant economic acceleration from a level where we're already fairly strong. You can't get that without the Fed not only really keeping rates where they are, but even considering rate hikes into 2024. That's not my forecast. I think the economy is going to be slower next year and that their earnings estimates are too optimistic. But this is a big disconnect that I think we really aren't shining a light on.
Laura, how close are we, and I don't mean Plaza Accord, someone dismissed that earlier this morning, but Laura, how close are we to where the stochastic history of strong dollar adjusts Fed policy, where Powell is overcome by strong dollar, like on DXY 105 tending to 106? Are we getting it close to where those dynamics take over Fed decision making?
I don't think we're there yet, Tom, and I do think the dollar is going to continue to strengthen significantly into year end. I think that the rate of change is really important when you think about the Fed, in taking that on as part of their decision. And I think when the Fed looks at the landscape today, they're seeing shadow tightening, I call it, coming from a lot of places. The higher oil prices, the dollar, the real interest rate dynamic. I don't think that they're displeased with that. I think this is kind of their bargain with markets. Like, we won't give you a lot of rate hikes if you will allow this tightening to kind of continue to bubble up in the background and squeeze demand over the longer term. I think if it moves really fast, that's when you start to see the Fed take this into place. And listen, you and I have been here before. I do not put it past FX to be the market that really breaks out. It is highly volatile when you least expect it. And I don't put it past FX, especially in the emerging markets, to really come out of left field and cause a broader financial market disruption.
I was talking to John, Laura. He's stuck in the United Kingdom. He's working on a project over there. And I was just telling him that it was amazing to see the autumnal leaves and the glow of October within the hurricane or whatever we're having in New York. The sun came out, what, a week ago?
Yeah, it's
something
been a long
like
time.
that.
Last time we were here.
Laura, it's a time of season where we go into the seasonal quarter and retail becomes important. What's the American consumer going to do?
Right now, it is fascinating that given how strong the economy is and given how much people are spending, consumer sentiment is still dragging. I really chalk that up to inflation. I think the Fed is patting themselves on the back that inflation is down to 3.5%, 4%. For the households, the sticker shock that they're still experiencing is a very clear and present pain point. So I think from here, the consumer slows. The student loan, starting up again, those student loan payments are a marginal impact to me. It's not going to be the main driver. But despite the fact that households really, I think, have a solid foundation, it gets slower from here because, frankly, this level of spending right now is unsustainable.
Do you think that that means hard landing? Does that mean recession, or does that just mean a slowing down and a sort of disinflating of the economic trajectory?
I've been in camp recession, thinking that the Fed, given the dramatic and aggressive nature of this Fed rate hike, is going to cause the economy to contract sometime. I originally had said the beginning of next year. Obviously, right now, the way things are going, that seems like it's going to be pushed out. I think all the reasons why I was thinking this would be a mild recession may be the reason why we just get a slowdown and not a full-on contraction. That list includes scarcity of labor. It includes the CHIPS Act. It includes just broader general underinvestment in our economy that we're playing catch up on now. These were reasons why I had sort of said, recession, but more mild, may keep us on the line of a soft landing. But either way, I think, when I look at the bond market, it's pricing in a slowdown. When I look at the equity market, it's not. And, listen, the equity market's a historically terrible indicator of the economic cycle. So I think we all need to acknowledge that just because equities are up, and they're not recently up, but just because they're up doesn't mean that we're out of the woods on the economic cycle.
Lorraine, thank you so much. FS Investments there, beautifully linking in foreign exchange with DXY rounded up to 106, seeing strong dollar this morning. The markets are interesting. It's not an abrupt move, but nevertheless a VIX over 18, and the Standard & Poor's 500 down 0.3%.
Coming up, we're going to be speaking with former FDIC Chair Sheila Bair, and it comes at a time where we're looking at a new rate regime. And my key question to her is just, can we survive this? What does this do to the banks? Did the whole banking crisis of earlier this year mean anything, or did it just show the resilience of an economy and a banking system that can, to use your phrase, adapt and adjust?
Hugely well-timed. Out of the academics of Northampton and Amherst, Massachusetts, and on to some real public service for the country during, to say the least, some trying times. And to stagger from Robert McTeer in the 80s to Sheila Bair from, the recent times, whither are banks? That's not a small issue. It's off my radar. I'm guilty of this. But there they are. It's not one and done with Silicon Valley Bank, is it?
And where do they lend, right? And we were in London last week at the credit conference that we put on, and we were talking about how a lot of these private asset managers really want to take on the role of these banks. The banks are giving it to them because they can't make a profit. So where does that put the regulatory oversight? Where does that put some of the questions around who's going to be doing lending at a time where lending is a lot more expensive?
You look at a monthly chart of the Keefe-Bruyette index, and the answer is southish. And do you come back and retest pandemic lows, which maybe was unimaginable here? In a timely conversation for Global Wall Street, Sheila Bair will join us. She's the former FDIC chair. Look for that. Futures modest deterioration. Futures at -11. The VIX out over 18, 18.09. We are on radio. We are on television. For Global Wall Street, this is Bloomberg Surveillance.
London will stay a financial center. It will stay our EMEA hub. We'll just have a rebalancing onto the continent. And actually, the numbers of who has moved across aren't that big. So it's sort of in the 200 level. And if you think about 15,000 people, that's sort of not that material. And so I do think both will basically continue to grow and continue to be very relevant. What will change, though, and the big thing that's changing, is actually the risk-taking is what's going to move. And so we've historically had risk-taking in the UK. That risk-taking and the assets that go with it, not the people alone, but the assets that go with it, that's the next phase of what we're now moving into. And that will be a material change.
We have an aberration in our country right now, but nonetheless, we still have to strive for unity. Sometimes you achieve it, sometimes you don't, but we have a responsibility to act in a bipartisan, unifying, transparent, accountable way.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. Get your fixed income fix. Watch Bloomberg Real Yield every Friday at 1 p.m. Eastern, right here on Bloomberg, your global business authority.
In general, in the globe, we are going through very challenging times in terms of macroeconomic macroeconomic picture. Of course, the geopolitical tensions are not helping at this stage. But I do believe that many investors still see the long-term potential of China. It's exactly how to navigate the current situation that makes our job even more important.
Over in China, Sergio Armati, the head of UBS, talking about the relationship in that nation as well as some of the fund exploration with respect to Credit Suisse and the whole assembly there. Today, we've been talking about a number of different events this week, in particular having to do with the strikes, Tom, and I was noticing the divergence between the companies that are getting close to resolving the strikes and those that are really in the heart of it. And you could see that with Disney and Netflix shares both up in pre-market trading on the news that we got that there might be some sort of deal with the Writers Guild and that they're going to get some sort of moving forward with respect to Hollywood. Disney shares up about 0.5%, Netflix shares up about 1%. Stellantis, on the flip side, down 1.3% as those strikes expand.
Well, the
today.
strikes expand, but I don't know how to conflate LA strikes of a really strange Hollywood system with people making $60,000 a year on a assembly line in Detroit. People conflate the two together, and I'm just not sure that's correct.
There is a way to conflate them that I think is really important, which is technological changes have kind of trumped all to sort of create a new urgency. Artificial intelligence very much in the forefront of the discussion over in Hollywood. This question also of streaming and how you get royalties, how you get fees. And over in the auto manufacturing side, the question of electric vehicles, new production facilities. These are the new technologies creating the frameworks of a lot of angst, how you ensure job security in a world that's moving really quickly.
It's going to be, to me, it's going to be absolutely fascinating. I don't see any other way about it. What do you make of this market this morning? To me, it's just extraordinary. I got a 2.11 on the real yield. And, there's some tension out there with that headline we saw earlier on higher yields, cycle high, hearkening back to the time of bear.
The question is, can we live with yields like this? And can we move with them moving this quickly? Can we live with this idea of a fast-moving freight train of people moving away from being bond bulls and going into being bond bears? And the answer is not clear, right? We've heard from guests who have different opinions. We just heard from Laura Rahm, who is talking about how, no, it doesn't seem sustainable. Others saying, yes, it is. And here we are at a time where we might be going into a blackout period for data. So we can't really understand the ramifications from the economic standpoint in real time.
In combat, sometimes people are called. Sheila Bair was of Kansas and the University of Massachusetts Amherst, a nodding acquaintance with Senator Dole of Kansas, and that began her public service to the nation. And then she was selected in 2006 for the boring job of being FDIC chair in the banking system. This extended out to a not so boring 2007, 8, 9. She survived to 2011. She is the author of 2 new children's books. They're out October 1, Money Wizards. I didn't read that in 2007. But Daisy Bubble about market speculation, that one I read cover to cover. Sheila Bair joins us this morning here in Another Time and Place from 2007. Sheila, if I'd read Daisy Bubble on that August afternoon in 2007, where LIBOR OIS went out 4 standard deviations, what would you have written about to sprightly 7-year-olds?
Well, to you, I would have said you should have read Daisy Bubble probably in 2002, 2003 when the housing bubble was starting off. Yeah, I would say to young people, as I say in the book, and there's some back matter in the book that talks a bit about the housing bubble and the more recent crypto bubble, that speculation is dangerous. You know, herd behavior is dangerous. How many times we told our kids, don't do something just because everybody else is? And bubbly markets are a lot about that. Gen Z has a word for it, fear of missing out, FOMO, you know, right. And everybody else is getting in. And then the bubble pops, usually by the smart money selling.
You were
saying... yeah, for the investor, they should stay away, kids or adults.
You were a saint, with accolade from Democrats and Republicans alike, about a patient approach in times of crisis. We had a banking crisis a number of months ago, and we're already back to fear of missing out. That crisis is over. Is it?
Well, I hope the crisis is over. As I wrote at the time, I thought regulators did overreact. I'm not sure 3 mid-sized regional banks failing was a crisis. They treated it as such. The rest is history. But yeah, I think more banks are going to fail. I think if properly managed, it will not be a crisis. Banks do fail. The reality is the very largest banks are too big to fail, notwithstanding our best efforts to try to kill that doctrine. And the smaller banks are heavily reliant on insured deposits, which are stickier than the regional banks are suffering some. They rely more on uninsured deposits where they're seeing outflows. But yeah, with the inverted yield curve, been inverted for over a year now, you know, if your deposit funding costs are going higher than your long-term loan rates, you got a big problem. And with CRE out there, I can only assume there will be more bank failures. I don't think it will be a lot. I think the FDIC and other government agencies have the tools to deal with it. But yes, I do over the next 12 to 18 months, I think there will be more bank failures.
Let's put together some of the ideas that you're talking about, the concept of excesses, bubbles, people chasing the FOMO trades, which we saw in mass over the past 10 years. And then this idea of a rate regime that harkens back to when you were FDIC chair for the first time. How much have we seen the excess bubbles kind of worked through the system, or are they yet to be worked through the system? In other words, are we still going to see that reckoning that people said would happen back in 2007, or back in, I should say, 2013?
Yeah, so I think there's some bubbles left that need to be popped. Hopefully it'll be gradual. You're seeing valuations come down. Commercial real estate still inflated, but you're seeing some of that start to correct. The stock market, I think it's probably got some ways to go down again. So it's just a matter of whether we can, the expectations are right, people understand what's going on, and we can manage it. And but yeah, I think there's still many shoes left to drop. And of course, just in terms of credit markets and distress in debt refinancings, we've got a lot of corporate debt refinancing over the next couple of years. A lot of that CRE debt is expiring, needs to be refinanced. So these are shoes that are left to drop, which is why, even though I'm an inflation hawk, I am so glad that the Fed has been hitting pause. I think they were going too fast. There's only so much of this transition to higher rates that the economy can absorb without triggering very broader problems in the financial.
Sheila, you've been saying that you think that ultimately it's good to have the discipline that higher yields that they do invoke. But you think it's been too fast. Do you think that ensures something of a recession that people are perhaps overlooking?
Well, I think if you go too fast, then you do trigger a crisis, and then the Fed has to do U-turn and ratchet back down, and you start this whole problem all over again. There's not much research that shows low rates boost, sustainable economic growth. Yeah, there's a lot of research that shows it harms productivity. Larger companies benefit much more than smaller ones. Actually, high rates help the smaller businesses because they get their credit from banks. It's easier to lend for banks if the rates are higher. And even though there's some pain in the banking system now, if we can transition into a more normalized higher rate environment, overall, I think that will make the traditional banking system, the banks that take deposits and make loans, stronger. Right. So, I've been on a lot of corporate boards since leaving. My sense is that they don't borrow to invest in productivity. I mean, that comes out of operating income. They want to do that anyway. So if you just make it cheaper to borrow, that goes into M&A activity, might go into buybacks. There's really no evidence that the ability to borrow cheaply by large companies goes into productivity. And I think the low productivity we've had since this very accommodative policy stance has taken hold shows that.
Sheila, thank you so much. Sheila Bair, the former president, Washington College of Maryland, former FDIC chair as well this morning. We haven't talked enough about it. It's been percolating there, but you get out a technical chart of the Keefe, Bruyette, and Woods Index, and I'm sorry, it's not pretty. There's just no other way to put it.
I mean, people say banking crisis averted, but not for people who own those shares and not necessarily in terms of valuations. But what Sheila was just saying there is at a certain point, there needs to be more of a reckoning that hasn't really come to the fore. And a lot of people have been pointing to commercial real estate recently, including some pretty big bank executives. So again, there's been a lot of threat, but it hasn't come to the fore yet, except for in pockets like the shares of these banks.
Yeah, we're going to have to see, to say the least. Coming up here on Bloomberg Radio, Paul Sweeney and I, Phil Camparelli, JP Morgan Asset Management. On the Open, young Pharaoh is in London on assignment on TV. It's the Bitcoin Open. We'll be doing that with Matt Miller sitting in for Mr. Pharaoh. On Bitcoin, Michael Zezas, George Kagovas, Sarah Hunt. This is Bloomberg. Stay with us.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
What do you consider to be the biggest challenge?
Infrastructure that supports trade is the biggest challenge. Our senior brother, President Adesina of the AFDB, estimates the annual deficit, infrastructure deficit in Africa to be over $100 billion. But that over $100 billion is actually also an opportunity for investment. So it is a massive, significant challenge that we are confronting. And my fear is that we may succeed in establishing a very effective legal construct and a very effective legal foundation for trade liberalization and investment liberalization in Africa. But all of that will come to naught if the infrastructure deficit is not addressed, because you will need the goods to move somehow, and you will need to have good trade corridor connectivity, ports, trade corridors that connect countries that are landlocked to the ports.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He called himself self-made day trader. Yeah. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, our fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
This is Bloomberg.
Good morning from New York City. For our viewers worldwide, I'm Matt Miller in for Jonathan Farrow. Ahead of a risk-off session on this Monday, we have equity index futures extending losses on concern about high for longer. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open, with Jonathan Farrow.
Coming up, traders bracing for a busy week of Fed speakers. The dollar hits its highest level since March as higher for longer fears continue to keep markets on edge. We begin with the big issue, and that is Treasury yields taking center stage once again. We saw a jump last week. Let's see what happens now.
Yields are rising.
The higher real yield story. Why are bond yields rising? So much of it's been driven by the recent stronger economic growth.
Economic growth in the third quarter has picked up.
Inflation indicators, whether you look at owner equivalent rents or oil prices, are starting to tick back to uncomfortable levels.
We're in an environment where the Fed is leaning towards potentially another hike.
Expectations for the next Fed rate cut have been pushed out into the future.
There's an acute awareness and concern on fiscal right now.
You've got a substantial amount of fiscal spending.
That's something that may actually even pressure Treasury yields modestly higher.
We're still not sure that we are at peak yet.
There's so much uncertainty on the path for Treasury yields.
Bond yields being higher, a Fed that's higher for longer is going to continuously put pressure on just the broader markets.
Joining us now, Morgan Stanley's Mike Zizas and George Goncalves from MUFG. Let me start by asking you, George, what you think about this new resurgence in yields. I mean, didn't we understand last week or in the past 2 years that the Fed was aiming for higher rates? And don't we know that they're going to hold it there until inflation is back down to 2%?
Look, the bond market's been skeptical, but I think they're finally starting to listen to the Fed. And this, to me, is not really, bond vigilantes really returning, but it's more about the bond bulls throwing in the towel. We've had a deeply inverted curve, a curve where, historically would be suggesting a recession is coming soon, which I still think that's the case. But nonetheless, while we're waiting, the bond market's respecting the Fed, and rates are normalizing from the belly of the curve. And we've been saying since really the midsummer that post-debt ceiling, we're going to have this supply deluge, and then the Fed staying on hold for longer. It was going to normalize the belly of the curve, and that's what hurts the most. It's the revenge of the bear steepener.
So I guess one concern, Michael, is that, inflation could be resurgent, and then the Fed has to continue, even hike again. How do you see prices coming under control?
Yeah, well, actually, we're pretty constructive on the idea that there's going to be a lot of pressures that push inflation lower into the fourth quarter. And it's not just some of the ones that are grabbing headlines, like the potential for a government shutdown to crimp demand or UAW strike. There's also just a natural give back that our economists have been flagging from consumption behavior over the summer around special events that isn't going to be there. And then on top of that, we've got student loan repayments starting again. We think you combine all of that, that's as much as taking down PCE by 1.3, 1.4%. Those other factors we talked about could easily drive GDP to a 0.1% quarter print. And we think there's a pretty meaningful risk of getting a negative payroll print. Now, none of this means there has to be a recession. We're still in the soft landing camp. Okay, but all of that suggests that what the Treasury market's pricing about the future Fed path might become a little more dovish after you start seeing some of this data. And that's the type of thing that should tell you that yield increases from here should be pretty limited. That should be pretty positive for bonds overall.
On the other hand, we have a risk, a wave of risks, I think, including the student debt repayments coming back online. Morgan Stanley's Mike Wilson sees consumer stocks losing their luster, writing, quote, "The technical breadth set up for consumer stocks looks particularly challenged. Price action is picking up on slowing consumer spend, student loan payments resuming, rising delinquencies in certain household cohorts, higher gas prices, and weakening data in the housing sector." George, this list goes on, and I think a lot of people have been repeating it over the past couple of weeks. What do you think about the headwinds for the U.S. consumer?
Look, I think that's a pretty comprehensive list, and I generally agree with what was said before. The problem is the Fed is keying off of lag data, and they're not minding their own lags of all these hikes that they put in place in a very quick and aggressive hiking cycle. The lags of all these hikes are going to hit on top of all those kind of economic headwinds. But as we heard from Chair Powell last week, forecasting the future is hard to do. So I think they're going to just wait until something breaks either in the economy or markets or both.
Maybe something breaks again, right? Because we've already had the problem with the banks. Let's get to, though, the data, because a lot is coming up this week. A lot of Fed speak, certainly, and some economic data. Bloomberg's Mike McKee joins us now for a preview. Michael?
Well, Matt, we could be talking about something that breaks, and that's the government. We'll talk about that in just a second. But we do have a busy week of data ahead, although not all of it is that important. Here's what really is going to matter, and I would point your eyes to Thursday when Jay Powell does a town hall with teachers. They don't get paid a lot of money, so I would imagine they will be questioning him about interest rates and inflation. Jobless claims may be that day. If the UAW strike distorts the numbers, they won't have a lot of information for the Fed and those who are thinking about trading on the Fed. Income and spending and PCE on Friday is the other big number because we get the Fed's favorite inflation numbers. They're expected to be better, but not a whole lot. And then Sunday, maybe data ends if the government shuts down. We have a lot of Fed speak as well this week. Kashkari, Bowman, Goolsbee, Cook, Barkin, and Williams all joining Jay Powell. We'll get an idea of how serious all of them are about raising rates one more time. They put it in their dot plot, but are they going to follow through? Whether they follow through may depend on the government shutdown, though. You put the calendar up for next week, and you see there's already a lot that we are not going to get information on. If the government shuts down, we won't get construction spending data, JOLTS, factory orders, the trade balance, jobless claims, and here's the big one, September payrolls. So I guess kind of the question for your guest, Matt, is if we don't get the payrolls report, how are Treasuries going to trade on that going forward? And then after that, the following week, CPI, if we don't get that.
Yeah, McKee, thank you very much for the suggestion. I'll put it to action right now from one mic to the other. Mike Zizis, what do you think about the problem of a government shutdown? It seems like a very high likelihood that we see that. And, of course, we've got the strikes as well. So lack of data, lack of jobs, does that concern you?
Yeah, it's concerning, right? And I think you have to take the government shutdown possibility very, very seriously at this point. And that's not a surprise. And everyone in Washington, D.C. is basically saying the same thing. Look, I think on its own, a government shutdown is not a huge event for GDP growth, right? In our estimate, it's about 0.05 percentage points off of GDP growth every week. So you need a really long shutdown for it to matter. But because it's coming on top of the UAW strike, which if that goes full strength, all 146,000 employees are striking for a 5 to 6 week period, that could take another percentage point off of GDP that's not in our forecast. And on top of all the consumer stuff that we talked about earlier. So for us, it's not necessarily the data that's coming up in the short term. It's really kind of what the October data would show in November. And if you get all of those events together, we think the November data is going to be really, really weak, right? And again, that doesn't mean that there's necessarily.
But those things are inflationary.
It's still very much being the soft camp.
Isn't the strike especially inflationary, Mike? I mean, fewer cars. We're already down to like 35 days in terms of dealer supply. You know, before the pandemic, it was 75, which maybe was too much. But at the worst point in the pandemic, we were at 20, which is far too little, and that drove prices up. You know, dealers adding $5,000 to $10,000. If you get that, and then eventually you're going to get higher wages as well, how could you see inflation coming back to 2%?
Yeah, well, listen, I think we're talking about different time frames here, right? In the very short term, you're talking about foregone supply, but you're also talking about foregone income, and how those things come out in the wash over the long term is pretty unclear. But in the short term, if it's taking away from growth and the market's been set on expectations that the Fed isn't going to hike through the end of next year, we think the downdraft in data you see in the short term could reset some of those expectations closer to what our economists are seeing. And that would tell you that yields don't have that much room to go higher from here.
George, you have been right on in terms of your market calls. Rates jumping higher, we're seeing that again today. Dollar bid, we're seeing that again today. Risk off, we're seeing that again today. How much longer does this go, in your opinion, as the market kind of gets used to or starts to believe what the Fed is saying?
Look, we've had muddy waters all throughout this time period. And I think that what Mike just mentioned is just going to make it even more compounding and confusing into the next couple of weeks. But it does put you into that window where there's not much time for the Fed to kind of assess things before the November meeting. So I generally agree that we're probably closer to the end of this kind of rate sell-off. But you always have that kind of last kind of move where people throw in the towel. And I think that's what we're going through right now. And when that takes place, that usually hits risk assets. And I think that's also what we're seeing. Typically, a government shutdown or any sort of disruptions would be bullish for duration and for fixed income. But we live in an upside down world. I mean, I think, to kind of answer the other Mike's question, without data, maybe traders will trade better because we've had data where sometimes it gives you the opposite reaction. So I think, we'll take it one day at a time next week.
Yeah, we've had kind of a fire hose. It's had a fire hose effect. Mike Zizas and George Goncalves are going to stick with us for more. Right now, I want to get a look at the stocks that are moving ahead of the opening bell. For that, we go, of course, to Abigail Doolittle. Abby?
Well, Matt, let's take a look at some of the movers beneath the surface, because we do have futures modestly lower at this point, but starting out with one stock that's popping, CarMax. Shares are higher. This, of course, after Wedbush upgraded the used car retailer to outperform from neutral amid improving market share performance. Foot Locker, on the other hand, was cut by Jefferies, along with Urban Outfitters, not shown to a hold, with the analysts there saying that incremental consumer headwinds lie ahead. Urban Outfitters is down about the same amount. And then Netflix up about 0.4%. This, of course, on the tentative labor deal struck with the Writers Guild between some of the big studios, including Netflix. Investors are optimistic that it will become reality.
Yeah, so much strike news, but here we have what looks like resolution to at least one of those on the writers' front. Abigail, thanks very much for that. Coming up, a government shutdown showdown.
A lot of Republicans over the past week been frustrated by the handful of conservatives who have blocked any movement. And so as that chorus might change, we may be able to see this potential change that we won't hit a government shutdown if they're willing to work with Democrats.
Conversation about that inevitability next. This is Bloomberg.
Crucially important, and I think we've moved from this attitude from it's an indulgence, a waste of time, almost an illness that needs a cure.
For something as universally important to human life as sleep, mysteries surrounding its necessity and utility have only just been recently uncovered.
Some of our biggest discoveries were in the 1970s or 1980s, and so it makes it a really exciting field because it seems as though we're uncovering new insights each and every day.
Some scientists are going further to find out how sleep and what happens there can be harnessed to further expand our understanding.
It's easy to memorize things. That makes you smart if you can spit back a lot of facts. But if you want to be wise, if you really want wisdom, you've got to know when and how and why to use that information. And that's what your brain figures out while you're sleeping.
Looking historically at the shutdowns that have occurred, and there's been quite a few over the past number of years, in general, they do not have a major economic impact. The issue this time is that we're also now seeing, the auto strike that is occurring. We're seeing increasing pressures on consumers from student loan repayments, higher oil prices. If there is a shutdown, there's obviously a political price to be paid.
Speaker McCarthy and his allies spending the weekend working on a short-term government funding measure with just 5 days to go until a potential shutdown. Party infighting continues between McCarthy and other conservative hardliners, with key holdouts, including Representative Matt Gaetz, calling a brief shutdown necessary.
If, the Department of Labor and Education have to shut down for a few days as we get their appropriations in line, that's certainly not something that is optimal, but I think it's better than continuing on the current path we are to America's financial ruin. I'm not here to hold the government hostage. I'm here to hold Kevin McCarthy to his word.
Meanwhile, President Biden placing the blame solely on Republicans.
A government shutdown could impact everything from food safety to cancer research to Head Start programs for children. Funding the government is one of those basic responsibilities of Congress. And it's time for Republicans to start doing the job America elected them to do.
House GOP members expected to move forward on 4 appropriations bills this week, but it still leaves Congress set to miss the Saturday deadline. Bloomberg's Anne-Marie Hordern joins us now. So, Anne-Marie, how inevitable is this?
Well, it does look like a shutdown at this moment is inevitable. What you're going to see tomorrow, a really key day. The Senate is working on their own version of the stopgap spending measure. And then you have the House coming back to session. And there's been a number of conversations over the weekend of what a new stopgap funding measure could look like. Could look potentially a higher cut in domestic spending from 9% to 27%. Also being weighed is that it actually could be longer, anywhere between 14 to even 60 days. And a debt commission potentially attached that to look at entitlement cuts. What Speaker McCarthy wants to do there, and I think a key phrase you heard from Representative Matt Gaetz, who continuously talks about a potential motion to vacate to get rid of the speaker, is he says enough time to get these appropriations done. So tomorrow what you're going to see is Speaker McCarthy try to push through 4 appropriation bills. And these appropriation bills, whether it's defense, whether it's agriculture, homeland security, trying to really show some good faith with that part of his party to then potentially also get a stopgap funding measure, continuing resolution through to keep the government funded after Saturday evening. The issue, of course, is that what you're going to see come out from the Senate and the House is going to look widely different, which is why it does look like a shutdown, even if they are able to get their own measures passed through each chamber before Saturday. It does look like it's inevitable because they're going to have to come together and figure out what can pass in each house.
All right, Anne-Marie, thanks very much. Anne-Marie Hordern there covering the government shutdown, the potential government shutdown for us out of Washington. Mike Zizas and George Goncalves are still with us. And George, let me ask how much the market cares about this. I mean, I guess we all expect it to happen, right? But is it just sort of par for the course these days?
Look, I mean, we've been a market that's like rolled from topic to topic. We go from the Fed to other central banks. Now we're going to dealing with auction supply this week and as well as quarter end. But it is a critical event, obviously, if we go into a government shutdown. But I think there's partially a fatigue of what happened earlier in the year around the debt ceiling, that maybe the market's kind of taking this a little bit too sanguine. And if it does become like a longer shutdown as well as just nonstop continuing resolutions, that really will hamper growth for sure. So I think that the markets are kind of taking this one day at a time, as I said before, but I feel like it is going to be super critical as we get towards Friday.
Mike Zizas, what do you think? I mean, George made an interesting point that maybe we'd be better without the data in terms of the stock market. In terms of rates, I guess if the government shut down for too long, it's almost perverse, but people buy treasuries, right?
Well, yeah, because the implication is that it's going to dampen growth, right? So, I mean, to your initial question of do investors care about this, they do. It's got to be one of the most frequently asked questions we've been getting over the last 2 weeks. But I think the power here is less in a potential for a long shutdown crimping GDP, but rather in it calling attention to all the other data downdraft that we've been talking about into the fourth quarter. All that together, and the shutdown is just sort of emblematic of it, would put pressure to at least limit yields rising further. And so we think investors are supposed to look at that and look at bonds more favorably instead of the way they've probably been looking at it over the past couple of months, which is, if I bought a bond, I lost some money on a total return basis. But over a 12-month basis, if you're buying them here, given the economic downdraft in the fourth quarter, we think you're going to be in a pretty good position to capture some really solid total returns.
It does seem like you should just back up the truck at these levels because even if you don't get the capital appreciation, which I assume you're expecting, you still get a decent return. What are the biggest risks, Mike, to your expectation of, I guess, soft landing and inflation coming back down to target? What are the biggest concerns for you?
Yeah, I mean, listen, obviously, if the fourth quarter data doesn't play out the way we think it would, then what's currently priced into the Fed's path is probably going to be pretty persistent, and that could push yields higher. Right now, for bond investors, that might mean some more short-term pain. But even if you think the Fed maybe isn't at the end of its hiking cycle yet, but will be within the next 12 months, and there's only perhaps a few more rate hikes on the table, we still think this is a pretty good entry point. You might have some short-term pain on a total return basis, but we think it's completely reasonable to expect high-grade corporate bonds, U.S. Treasuries, to kind of push close to double-digit total returns over the next 12 months.
George, what do you think? I mean, what's your outlook for 12 months from now, and what are the biggest risks to that?
Look, I mean, maybe we could zoom in on the next 12 days versus 12 months. Like, I think Mike is probably right on the medium term that we're trying to make a topping process here in rates. We just don't know if it goes any further. And this has been a very technical market, and it becomes illiquid very quickly. And so if we have this kind of gap higher, might be a great buying opportunity, but not many people will show up to buy the bond market, perhaps, if we have this big sell-off, because everyone's going to be scared after seeing what just took place. Meanwhile, you kind of look forward down the road, the rates should be heading lower given that sort of economic outlook that I think we both share here. But I do think that these technical factors, as well as the wild card around what happens overseas with if there's a need for foreign intervention, if selling of treasuries, that still kind of hangs over the market's head as well. So I do think that the risk is to one last kind of rise in rates, and then that really will start to crack the risk markets and then get money back into fixed income.
Mike, I know you're the head of fixed income research, but what do you think about the equity indexes here? We've had almost a correction in terms of the NASDAQ, is down 8%, let's say, since the end of July, beginning of August. The Russell 2000 is down more like 11%. It does seem like equity investors are a little worried.
Yeah, I mean, listen, you had a quote from my colleague Mike Wilson earlier, and I think that says it all, right? If you see the economy weakening, both in growth terms and in inflation terms, then that's not a great consumption backdrop. It's emblematic of not a great consumption backdrop. And in a market where the multiples expanded substantially, you should expect some give back. So it's one of the reasons that we've got more confidence in bonds delivering solid returns over the next 12 months. And we think it's going to be a tougher road for equities.
Mike, great to have you with us. Mike Zizas there talking to us from Morgan Stanley, where he's head of fixed income research, and George Goncalves from MUFG. Also great speaking with you. Thanks so much, gentlemen, for joining us. Coming up, the morning calls, and then later we're going to talk with Sarah Hunt of Alpine Saxon Woods, joining us around the opening bell with her outlook for what assets do in this higher for longer environment. This is Bloomberg.
Chinese technology companies, let's say Alibaba, Baidu, Tencent, they have gigantic market values, and they're very prominent in China, not as prominent outside of China as obviously in China, and certainly not that prominent in the United States. TikTok, by contrast, is not in China, but it's gigantic outside of China, of the United States, and everywhere. What did TikTok do that enabled a Chinese-based company, parent company at least, to do so well outside of China?
We think it's challenging to build a global company in general, but the best ones we have seen so far are ones that take very consistent global learnings and adapt them to the local countries that they are operating in. So you need to be global and local at the same time.
covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
Welcome back to Bloomberg The Open. I'm Matt Miller in for John Farrow. Let's get to the morning calls. First up, Jefferies downgrading Nike to a hold, pointing to slower consumer spending and macroeconomic headwinds out of China. China, really a big story today with, it looks like another blow up, or I guess continued blow up in property. Next up, JP Morgan upgrading Dow to overweight, highlighting the stock's reasonable valuation and strong balance sheet. This is formerly Dow Chemical, now Dow Incorporated. Finally, Guggenheim upgrading Microsoft to neutral, saying that generative AI narrative is too positive a force to contend with. You can see Microsoft shares down in the pre-markets, not having much effect on that as the entire market seems a little bit risk-off. You saw equity index futures, they are down. We see bond yields rising again, so there's a lot for the equity market to contend with today. Coming up, we're going to talk about that. Really, the main issue is the higher for longer, or high for longer, as some prefer to say, environment. Could mean good things for the energy sector. That's the view from Sarah Hunt of Alpine Saxon Woods. That conversation next up at the opening bell. This is Bloomberg.
don't think we can replicate Tesla. Tesla is a unique because when they founded and then the personality behind it, the product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but Xpeng is Xpeng. We want to focus on what we think is important for our customers. Our customer like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
It's got about 25 seconds to go until the start of trading on Wall Street. You can see that equity index futures are down. And the problem is investors are actually starting to believe the Federal Reserve when they say we're going to keep rates high for a fairly long amount of time. There you hear the opening bells. You can see the New York Stock Exchange here and the NASDAQ there. The NASDAQ, by the way, down about 11% since the end of July. So I think we're in solid correction territory for that index. Take a look at, the Russell 2000. The Russell 2000 down 11% since the end of July. The NASDAQ only down 8%. Let's switch up the boards and take a look at the Bloomberg Dollar Index, because I think that's one of the most interesting assets this morning. Right now at 1262, so the highest level we've seen since March, which feels like so long ago. The 10-year yield climbing ever higher, now at 452.73, approaching levels that we haven't seen again since 2007. NYMEX crude holding in that $90 range. West Texas Intermediate trading for $90.31, and we're seeing Brent still maintaining a level under $95 a barrel, but very close to that. And that's a concern, I think, for the equity market. One stock to watch, speaking of equities, at the open is Warner Brothers. Film and entertainment stocks have gotten a boost as striking screenwriters reach a tentative new labor agreement with Hollywood studios, including Disney and Netflix. Bloomberg's Abigail Doolittle joins us for more with what the end of the strike could mean for these stocks. Abby?
Indeed, Matt. We do have a potential resolution here to this very bitter month-long strike with Hollywood. The Writers Guild of America, representing more than 11,000 screenwriters on Sunday night, last night, said that they had reached a tentative deal on a new contract with some of those big entertainment companies. And it's interesting to see them a little bit mixed right now, suggesting that investors are maybe they want more, which we'll be talking about in a moment. But in the coming days, even as soon as tomorrow, we could have a vote with the Guild members voting on whether to accept the deal. They basically got much of what they wanted, had demanded, including increases in compensation for streaming content, concessions from studios on minimum staffing on some of the television shows. The Writers Guild, their committee, their comments really bubbling, saying this deal is exceptional. On the other hand, the entertainment studios basically acknowledging that a tentative deal has been struck. Apparently, language around AI is the one sticking point. But I think the reason that we don't have these stocks really flying higher, Netflix is up more than 1%. SAG is still on strike, of course. This is hopeful that maybe the actors will also find some kind of a deal. But right now, if this deal for the Writers Guild is in fact struck, it means only the late night shows will be restarting because they don't have actors. So stay tuned, but some optimism here that, again, this bitter, bitter feud in Hollywood, that maybe it's coming to an end.
All right, so could see the potential end of one or even two strikes. Abigail, thanks very much for that. Abigail Doolittle looking at the reaction in those stocks. Let's turn to tech, though, right now. Big story on Amazon today. It's going to spend as much as $4 billion to buy a minority stake in generative AI startup Anthropic. The CEO, Andy Jassy, writing, quote, "We have tremendous respect for Anthropic's team and believe we can help improve customer experiences through our deeper collaboration." The idea is Anthropic would use Amazon's cloud services and chips, and of course Amazon already promotes this business. Bloomberg's Ed Ludlow joining us now from San Francisco with more on this. I think partnership is probably a good word, Ed.
Yeah, it's interesting to understand the mechanics of it. As you said, Anthropic will migrate its software into the AWS cloud, but also make use of Amazon's proprietary silicon, the AI accelerator Trainium on the training side and the AI accelerator Inferentia on the inference side to build its next generation of large language models. 4 billion up to 4 billion. I think what I'm hearing in the first instance is it's more like 1.25 billion, and we go from there upwards. On the semiconductor side, it's interesting because it is a vote of confidence in AWS's proprietary silicon. We talked so much about NVIDIA and the H100 AI accelerator as being the kind of benchmark for compute in the building of large language models. But the other way of looking at it is this just Amazon paying an AI startup to use its chips, kind of a reverse revenue situation, which I also find interesting. Claude, which is Anthropic's foundation model, was already available on Bedrock. And Bedrock is basically Amazon's open source platform where third parties can either build their own large language models or use the template for those that already exist. And later on in the show on Bloomberg Technology, AWS CEO Adam Selipsky will be on the program. And there are a number of questions to ask about why Amazon did this. You know, they've been flexing a lot their own competence in the field of generative AI and also building of foundation models, but they're making a sizable investment here. One quick point, Matt, Google is already an investor in Anthropic and also holds a minority stake. So there's an element of competition and frenemies here, which I quite like.
Well, first of all, I love the name Claude. That's fantastic. Did you say you're going to have who's going to be on your program? AWS boss?
Yeah, the AWS CEO, Adam Selipsky, is going to be on the program later today. And I just have so many questions about how this is going to work in practice. Like, why use someone else's technology versus build your own? You know, Amazon usually does it on its own. But if they go the full 9 yards and do invest $4 billion here, raises the question why they didn't just buy Anthropic outright earlier in the year when it was at a much lower valuation.
Yeah, fascinating. I'll be tuned in to watch that for sure. I mean, AWS, obviously the biggest cloud operator in the world. Plus, as you point out, they make their own chips, and typically they do all of their own work. So this investment is a really interesting deal. Adam Selipsky joins Ed Ludlow and Caroline Hyde at noon today or thereabouts. Definitely tune into Bloomberg Tech for that. Now, from new tech to old, let's talk about HP. Remember Hewlett-Packard? Those shares under pressure as billionaire investor Warren Buffett continues trimming his stake in the computer and printer maker, selling 129 million shares according to the latest SEC filing. Bloomberg's Katie Greifeld joins us now with more on HP. Katie?
Hey, Matt. Yeah, Berkshire Hathaway unloading HP shares yet again this month. Shares currently flip-flopping at the moment, slightly higher right now. They were down as much as 4% in the pre-market after Berkshire to close in a filing that share sale. And that sale took place over 3 transactions between the 20th and the 22nd. And it follows Berkshire's earlier sale of about 160 million shares just a week or two ago. Now, rewind. Remember that Berkshire began building up this stake in the PC maker last spring. And looking at the filings, it looks like Berkshire may be rethinking that position now. And remember, we got HP's latest round of earnings late last month. Revenue dropped by nearly 10%. That ties back to China. And HP also lowered its full year profit forecast. So you add it all together, it's been a painful stretch for HP. Of course, it's still about unchanged on the year, maybe down about 1% or so, but shares have fallen more than 20% since just mid-July, Matt.
All right, Katie, thanks very much for that. Katie Greifeld looking at HPQ for us. Let's turn back to now the higher for longer narrative. Sarah Hunt of Alpine Saxon Woods weighing in on the market impact, writing, quote, just as all have settled in for a nice soft landing, it looks like some of the tailwinds may be ebbing. The market is starting to absorb the higher for longer message that, to be fair, the Fed has been singing all along. And that realization is not going gently for equities. Sarah, I'm pleased to say, joins us now on a day when it looks like we're going to see more equity index drops. The NASDAQ, as I mentioned earlier, is about 8% off the highs we saw in July. The Russell 2000 is down 11% from the end of July. So it's weird, Sarah, that we're talking about, and everyone seems to agree that a soft landing is coming, but we're getting these recession warnings from the stock market. What's up?
Well, you've got a combination of factors going on, right? I mean, first of all, we were going to have a big recession. It was going to happen early this year. Then it was going to be shifted to the second half of this year. Then it wasn't going to be a recession at all, but the Fed got everything just right, and it was going to be a soft landing. I think it keeps evolving as we keep seeing events overtake what the themes are in the marketplace. And I think right now, I mean, higher for longer, when you really are just going back to 2007 levels, as you mentioned earlier, the recency bias that we all have for low interest rates, we should be reminded that that's not the norm, historically speaking. So I think that there's really a catch-up that has to happen here because bonds have been looking at one thing and equities have been looking at another, and they haven't really been aligned.
Is the Fed guilty of, leaning on this recency bias? I noticed that on Wednesday they said rates are going to get back down to 3.9% by the end of 25, 2.9% by the end of 26. Now, I realize forecasting that far away from an organization that has a pretty poor record of forecasting isn't so key, but why do we feel the need to push rates down? I mean, the average over the past 50 years has to be closer to 5, right?
The average is closer to 5, but you have to look at how indebted governments are, right? So if you're looking out further than that and you start to see that all the governments that now have to pay those rates on government debt, it starts to become a scarier proposition. So I think part of it is, maybe we could survive at a lower rate than 5%, but I think that the zero bound and the negative numbers that we had post the financial crisis just had driven a lot of odd things to happen, and getting back to normal is not necessarily a smooth path.
Well, last week, all the bears seemed to capitulate, or the final bears. And at the same time, we're looking at a UAW strike that could stretch, right, expand and stretch, a government shutdown that seems pretty much inevitable, and a consumer that at least, if it's stronger than it was pre-pandemic, it at least is weakening, right? With less savings and more bills coming due.
Absolutely. And I think the problem is that once you finally get to the point where the market was just going up and people were expecting it to go down. So people finally capitulate and go, okay, maybe it's not going to go down so much. And then you really start seeing these tailwinds that are somewhat the long variable lags that we've all been discussing ad infinitum since the beginning of the year. And I think that there is some real concern about weakness in the consumer. All of the things you just mentioned, higher oil prices take a bite out of everything. That number of how much more households have to spend every month is not a small number. And even if inflation comes down because of base effects, it doesn't mean that that number gets smaller immediately. And I think that there's a real spending issue coming up, and I think that that's going to impact earnings. And I think that's where we are a little bit more cautious and think that a 12%, which is consensus for the S&P next year, seems a little high to us.
Earnings, I guess, one of the things I was hearing over the weekend, Sarah, is that now earnings maybe are more important than the Fed. And I guess it could be bulls that are looking for something, right, in the face of what could be another hike and 2 fewer cuts. What's your outlook for earnings? How do you see that argument?
Well, I think it's difficult because you had this big push in inflation, right? And if that was good for earnings because top line revenues grew while margins were still strong, I don't understand how inflation coming down is not supposed to be bad for earnings. And I think that we've had this idea that somehow we can just continue to grow from where we are. And I think that's very difficult, especially if we do get some reduction in inflation. You're seeing costs go up across the board. Labor costs are going up. I mean, that's part of this whole discussion that's going on with the UAW and in Hollywood and everywhere else, and you've got higher energy and food prices. So it's hard to see how margins don't and input costs don't start to squeeze margins. So I think that makes earnings, especially the idea that they're going to grow above 10% next year, is a little trickier for us to get our hands around.
So what do you do right now? Do you buy defensive stocks? Do you buy rates? Do you start moving out the curve? What do you do if you're worried?
I think that you have to look for businesses that are going to grow, hopefully, in any environment. And you have to look at we're talking about some big thematic stuff. Like there will be an energy transition. It will take a lot longer than everybody is expecting it to. But in the interim, I think liquefied natural gas, I think the stocks that play into that, I think that they've got a good runway going forward. Energy stocks are higher, but not nearly as high as the oil price right now because people don't believe that oil prices are going to stay up here. And they may fluctuate from here, but I think you've got a longer tail investment that people are willing to look through because they're expecting a transition much quicker. We also like companies with really good balance sheets. Some of the defense stocks, I mean, speaking of defensives, have really been getting hit very hard as we had this huge push in growth stocks that pretty much obscured anybody else in the market over the last year. So I think that there are good places and there are good balance sheets, but you have to be looking at the valuation, which for a while we haven't had to do. And you also have to be thinking about what does the world look like over the next 3 to 5 years and where is investment going to go? Because that's ultimately where you want to be investing.
Sarah, great to get some time with you. Thanks so much for joining us. Sarah Hunt there, coming to us from Alpine Saxon Woods, where she is Chief Market Strategist. Coming up, President Biden heads to Detroit.
All of the parts distribution facilities at General Motors and Stellantis are being called to stand up and strike.
Our team coverage up next. This is Bloomberg.
did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is gonna be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
I know one of the reasons you're here in Marrakesh and in Africa, because you see the enormous potential this continent has as a source of renewable power for electrolysis, right? That's the process by which hydrogen is extracted from water. Tell us about Africa's potential.
Africa's potential is the best in the world, and it's Africa's shot now. It's Africa's turn. What will stop Africa rightfully taking its turn will be lack of progress on technology. Companies and governments around the world choose Fortescue because we are the world leaders in technology, world leaders in next era electrolyzer design, cables, solar, all the tech which is moving our world on from having to rely on dinosaur era fossil deposits of oil, coal, and gas to simply today's era of machines which make machines to harness all that beautiful renewable energy and give all the mobile energy, all the fixed energy this world could ever need by many times. Those countries who resist that are denying Africa their opportunity. And I'm saying, stop it. Let's get in behind Africa.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
I found myself in a spot where I was constantly getting new challenges. A lot of, I think, the best mentorship I had at Bridgewater is because people often saw in me the potential to do things I didn't even see in myself yet.
We can and will go all out if our national leadership decides the companies aren't willing to move. Stellantis and GM in particular are going to need some serious pushing. All of the parts distribution facilities at General Motors and Stellantis are being called to stand up and strike. We will be striking 38 locations across 20 states, across all 9 regions of the UAW.
That was UAW President Shawn Fain calling for an expanded strike, with General Motors and Stellantis facing walkouts at 38 more facilities after talks last week failed. President Biden heading to Michigan on Tuesday to join the picket line ahead of Donald Trump visiting on Wednesday in lieu of a GOP debate. He's going to skip that one again, too. The White House insisting on the possibility of a win-win deal.
He is proud of being the most pro-union, pro-worker president, not only compared to the Trump administration with its anti-union policies, but really compared to any modern president. You're not going to find somebody who has more consistently stood with unions. Now, having said that, it's also the case that these auto companies can thrive in a win-win deal that does what the president has called for, which is to say that record profits should lead to record pay and record benefits for the workers who are creating all that value.
Let's get to our team coverage now. Bloomberg's Kayleigh Lyons in Washington, D.C., and David Welch, our bureau chief out of Detroit, joining us to talk about this. Kayleigh, first off, I think interesting, maybe surprising, exciting. The president is going to go and join, what, the picket line? He's going to stand with the unions in D.C.? I mean, this is going to be, invigorating, I guess.
Theoretically, Matt, it could be. This would really be likely the first time any president in U.S. history has gone to join striking workers at the picket line. But that is exactly what President Biden is planning to do tomorrow. He has accepted the invitation of Shawn Fain, the UAW president, because remember, Matt, in making the announcement of the expansion of the strike on Friday, he said, "We welcome anyone who supports our cause to join us at the picket line, President of the United States included." So, yes, you are going to see President Biden there tomorrow. But, of course, that front runs by just one day the plan planned address to UAW workers from Detroit of former President Donald Trump. He will be counter-programming the second Republican primary debate on Wednesday evening, addressing the union. Both of these men really competing for the auto workers as voters and wanting their endorsement, because of course the UAW has yet to endorse former President Biden or any other candidate for that matter in the 2024 race. Now, we understand that former President Trump is going to make a lot of his remarks about the transition to EVs, the idea that this could outsource jobs for China, for example, try to fire up union workers on that front. The EV push, of course, something that President Biden has pushed for very heavily, but he also has dubbed himself, as we just heard Secretary Buttigieg say, as the most pro-union president in U.S. history, and he's going to try to prove that tomorrow as he joins these workers on strike.
Right, and well, and he wants the EV infrastructure to be here in America. That was pretty clear from the IRA. Let's get over to David Welch right now. And I mean, my question, David, is could there be a win-win? Because the unions, although they accepted a deal to help the companies survive post-financial crisis, they kind of put those companies in ruin with the previous deal into the financial crisis. So, you know, could there be a win-win, or are they going to drive costs up so much that these companies aren't going to be able to make any margin?
It depends on how much. So first of all, you know, labor's like 5 to 7% of the cost of a vehicle. So even if they got a 20% pay raise, you know, that's 1% on total cost. So look, this isn't debilitating what the union wants, unless they get pensions and they get retiree health care. And it doesn't look like they will. Sean Fain hasn't talked about that in his last few addresses. He's talked more about cost of living allowances, raises, job security. So there is a way, and I think it's how it is shaping up. If you look at the what Ford has agreed to so far with the union, there is a way that the workers will get very nice raise, better benefits, and it will definitely drive up costs. There's no question about that. But the companies can still remain very profitable. They'll be a high-cost producer compared to their competitors, but they will be very profitable.
What is the likelihood, David, and I've been thinking about this all weekend, that these unions for GM, Ford, and Stellantis get a great deal, and it's strong enough to bring in workers that are building Hondas or BMWs or Teslas that aren't in a union?
That's the union's goal. They want to be able to, you know, basically show a big victory flag here to those workers, particularly Tesla, but all of them. The problem is the union's never been good. They've never succeeded at organizing Japanese, Korean-owned plants, even German-owned plants. Has been mostly failure for them, and they made very little headway with Tesla. So they're going to need a very good contract to do it, and they're going to have to do a much better, much different kind of sales job than they have in the past.
This is one of the things that President Biden has said, Kayleigh, that unions bring up wages for all Americans, even those not in unions. This is a chance also for President Biden to show that he's energetic, to show that he, you know, has vitality. Is he going to be able to do that?
Well, certainly he'll try, because, of course, this isn't just the current U.S. president. This is someone who is seeking to be president again, running for re-election in 2024 and trying to be out there on the campaign trail, visiting all these different states as he tries to tout Bidenomics, the resurrection of the American manufacturing economy that he is trying to bring about. And, yes, the rise of U.S. labor as a force within the wider U.S. economy. So he is going to try to do that, Matt. We'll all have to wait and see how things actually turn out tomorrow.
Kayleigh Lyons and David Welch, thanks very much for that. Coming up, the market-moving events you need to be watching next in our Trading Diary. This is Bloomberg.
maybe I should go do something else. I can't do anything better than I'm already doing. I've already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
This is Bloomberg.
This is Bloomberg's The Open. I'm Matt Miller in for Jonathan Ferro. Take a look at some of the moves we're seeing across assets. Bloomberg U.S. Dollar Index, the strongest level we've seen since March, so it's climbing higher. If you look at rates, we have the 10-year yield at the highest level that we've seen since 2007, making new highs there. And, of course, equity indexes are trading lower on concern about that higher for longer March. Time now for the trading diary, what you need to be watching this week. Minneapolis Fed President Neil Kashkari speaking at 6 p.m. Eastern. Tuesday, tomorrow, President Biden, as we said, heading to Michigan to join the UAW picket line. Fed speak picks up on Thursday with Chair Powell, Goolsbee, Cook, and Barkin. Plus, we'll get another U.S. GDP and a round of jobless claims. And finally, the government shutdown deadline coming at midnight on September 30th. This was the countdown to the open. This is Bloomberg.
Crucially important, and I think we've moved from this attitude from it's an indulgence, a waste of time, almost an illness that needs a cure.
For something as universally important to human life as sleep, mysteries surrounding its necessity and utility have only just been recently uncovered.
Some of our biggest discoveries were in the 1970s or 1980s, and so it makes it a really exciting field because it seems as though we're uncovering new insights each and every day.
Some scientists are going further to find out how sleep and what happens there can be harnessed to further expand our understanding.
It's easy to memorize things. That makes you smart if you can spit back a lot of facts. But if you want to be wise, if you really want wisdom, you've got to know when and how and why to use that information. And that's what your brain figures out while you're sleeping.
How do you compare the pleasure of being Secretary of State, Senator, First Lady with being a grandmother?
Well, actually, there are similarities. Negotiating with 3-year-olds is about as hard as anything I did as Secretary of State.
Slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise. It's noise versus signal. Now, more to the point.
What is the lesson or the observation?
This is Bloomberg Markets with Paul Sweeney and Matt Miller.
We got a lot of green on the screen here, but the volume is light.
We constantly underestimate the strength of the U.S. consumer.
This is a market that's much more optimistic or bullish than maybe central bankers are.
Breaking market news and insight from Bloomberg experts.
There's still some concern out there in the market that there is room for things to deteriorate a little bit more than what they're indicating.
As small and medium-sized businesses struggle, they don't present as much competition.
The supply chain has still got dislocations globally and here in the U.S.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
Good Monday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. Coming up, we're going to check in with Nathan Dean. He's a senior U.S. policy analyst with Bloomberg Intelligence. He's in Washington. He is our go-to voice on whether this government is going to shut down or not. So we're putting the pressure on him. Plus, Lydia Bosor, EY, Parthenon, senior economist. We're going to get her thoughts on this U.S. economy, the Fed, inflation, all that good stuff. But first, let's kick this whole thing off with John Tucker and the Bloomberg Business Flash.
All right, you know what? We're seeing a bit of a turnaround, especially in tech-heavy NASDAQ 100. Now pairing some of the earlier losses, shares of NVIDIA. We have Amazon up 1.5%, Apple's up 0.4%, Netflix, that's up 0.8%. The 10-year Treasury yield coming off earlier highs, and that's helping the tech picture especially. Still, economist Dennis Gartman, talked to him earlier today. He says the Fed is standing in the way of further price gains for stocks.
The Fed is going to continue to be, I think, detrimental to share prices. It's going to continue to hold a tight monetary policy for a much longer period of time than people want to anticipate. It's going to be at least late into 2024, maybe into 2025, before the Fed begins the process of allowing the overnight Fed funds rate to decline.
Right now, the 10-year yield, 7 basis points higher. That's at 4.51 right now. The S&P 500, unchanged, 4,319 on the index. The Dow Jones Industrial Average, 66 points lower, and the NASDAQ 100 right now is just 2 points lower. We check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Matt and Paul.
John Tucker, thank you so much. We appreciate that. Matt Miller, Paul Sweeney, in the Bloomberg Interactive Broker Studio. We're live. We're also streaming live. How about that? On YouTube. So head over to youtube.com and search Bloomberg Radio.
What an exciting day.
What an exciting day.
Dude, there's so much fascinating stuff. I mean, we're going to talk, I'm guessing we're going to talk to Ritika about Amazon in just a second, because that's huge. Plus, you got possibly the end of the strikes on the West Coast, which is a big deal.
Because if you notice, the fall schedule is all like game shows and reality, where you don't need any writers.
Yeah, well, they've done that to themselves.
Yes.
We have the president of the United States may go join a picket line.
That doesn't happen very often.
I don't think that's ever happened. Certainly not in modern history.
Very pro-union.
And then later on the program, I've got an old friend of mine, George Byers-Kaufman, who runs the biggest car dealership. One of the biggest car dealerships got to be in Central Ohio, but also they're a huge Ohio State booster.
Oh,
and did you see this weekend's game?
What a game. What a game.
Unbelievable.
Yep.
I'm not even much of a football guy, but
what
wow.
happened to the luck of the Irish? They didn't have it there. But all right, let's get right to the business here. Ritika Gupta, a good buddy of ours. We haven't seen her in a while, but she covers all the markets for Bloomberg, and she joins us here in our Bloomberg Interactive Broker Studio. Ritika, what are you looking at?
I just don't even know where to start, but you did outline some of it. So let's start there with some of the strikes over in Hollywood, first of all. So I was looking at some of those film and entertainment stocks. They were rising pre-market. I am looking at Paramount now, though, and it is down. So a little bit of a confusing session that we're seeing. But they were higher on the we know the striking screenwriters, and apparently they've reached a tentative new labor agreement with the studios, so including Walt Disney and Netflix. So that would have settled, one of the two walkouts that we saw in this. But again, it would be a new 3-year contract, increasing those royalties, the mandatory staffing, and what we're seeing in the writing rooms and all the problems there. I mean, and then we
getting some protection against AI, which no one knows really what the risk is, other than we know it's a risk, so we need some protection.
Yeah, the AI was a big part of that. I think we feel like we still need, like you said, more information on that, because that's something that we're still kind of waiting to see for. And then you mentioned UAW as well. Kind of we're seeing those big three, the stocks a little down today as well.
But it seems like there's a little bit more positivity on Ford, I guess, versus Stellantis and GM. And I guess that's
historically they've been closer to the unions. The union's like a family-owned company. Bill Ford takes, he's personally involved. And when you have an owner, it's not like the biggest shareholders of General Motors and Stellantis go to the union negotiations, but here they have an owner with whom they can speak. And so I think, Ford gets along better.
I read a really interesting stat on unions, which, I mean, maybe as a Brit coming here, I didn't realize just 50 years ago how much strength that they had.
Right.
So I think I read that they're about a quarter of the private sector, and now it's something like less than 6%.
Yeah, I mean, all those manufacturing jobs in the U.S. over the last 50 years went overseas, and along with them were a lot of union jobs, and ergo
overseas, not to the UK.
No,
by the way.
Yes, they went to Asia.
But I feel like the UK was a huge union country, right? Didn't Thatcher just come in and break all that?
I mean, yeah, that was
or that's at least the
that was the
prevailing
coal
narrative.
miners and all those kinds of
that was definitely a whole Thatcher era thing. But I mean, I just think it's interesting.
That was before Ritika was even a glitter in her mother's eye. What's that phrase? I don't know that phrase. Anyway.
But I mean, I just, like I said, speaking to this kind of summer of strikes that we've had, I mean, this is a time when I think wage inflation is higher than inflation. It's sticky. So like, this is really a lot of power in the
I will say, I was talking with Mark Zandi, chief economist at Moody's over the weekend, and he pointed out that.
What do you mean over the weekend?
Over the weekend, we were messaging about inflation. What do you do on the weekends?
Watch football.
No, Zandi.
We don't message about inflation.
Exactly.
Zandi pointed out, and I messaged him because he was quoted in a Bloomberg story, and the title of the story is "People Hate Inflation."
Yes,
I do too. So I said, "Hey, let me message Mark," because he was quoted in the story. He said in the story, it costs. This is a direct quote. $734 more each month to buy the same goods and services as 2 years ago for households who earn the median income.
Wow.
So for the average household in America, they're paying an extra $734, which, by the way, to me, that's already a huge number, an extra $734 each month to buy the same stuff as 2 years ago. And I was like, holy camole. But as you're pointing out, Ritika, I thought, well, maybe they're getting $734 more each month. Not the case. I wrote and asked Mark. He says no. In fact, they're getting only $211 more each month. So for the average household they've seen pay go up $211, but their stuff costs an extra $734. That's no bueno.
And there's also other factors that we talked about, the student debt. When I've heard a lot of economists saying that actually could have quite a meaningful impact on.
That's going to be another
spending.
$300 a month,
and that's October
on average.
Right? Yep.
And I read, I think that it was like the remaining student debt when it re-begins is like $37,000. So, you know.
All right.
For the average.
Yep. The average student.
Thank goodness my mother was a college professor, because then I got free tuition.
Right, you got comped.
Yeah,
as they say.
So,
all right, Ritika Gupta.
Good job.
Thanks so much. We appreciate it. Ritika Gupta joining us once again. It's great to have her back in the studio here. I took my 1993 bonus and paid off all my student loans from business school. It was a good year, 1993.
Yeah.
Boom, just knocked it out.
I was born too late.
Yeah.
You know. I would have loved to have been in on that.
Yeah.
Back when you could work on the floor and just like follow the crowd to make money, literally.
Yep. And be just a corporate bond salesperson to make tons of money. That was the day. All right, let's figure out what's happening down in Washington, D.C., because they have no idea what's going on down there. They're not even back like in session. I mean, they're coming back tomorrow. I mean, the government's about to shut down and they're still on some holiday.
I think it's very popular in Washington, D.C., to not do your job.
Right.
I think that's what the constituency wants.
You think so?
It seems like it.
All right. Nathan Dean, I'm going to blame him for all this. Nathan Dean is our senior U.S. policy analyst for Bloomberg Intelligence. His job is to make sure this government works. He's not getting it done here. Nathan, talk to us about where we are with this possible shutdown. What's the feeling in Washington, D.C. these days?
Yeah, so, over the weekend, Speaker of the House Kevin McCarthy talked about trying to pass 4 appropriation bills. There's been talk about some Republicans bypassing the Speaker and working with Democrats to do something called a discharge petition. But if you're sitting in New York City, all you need to know is that nothing really has changed. I mean, we're heading towards a shutdown Saturday night. There's a lot of political fireworks that have to happen this week, but we just aren't seeing any movement at this point that the Speaker wants to actually do a deal with the Democrats and try and avoid this type of situation. So I think we're probably around 70-80% chance that we're going to have a shutdown next week.
So, Nathan, is the choice for the Speaker, I'm assuming, Speaker McCarthy is kind of driving the bus here, is his choice, I do a deal with these radical Republicans, this small group of Republicans, or I reach across the aisle to Democrats and deal with the political backlash there? Is that his choice at this point?
There's no deal to be done with the radical Republicans. They want to shut down the government, right? Isn't that what they want?
It's so much more of like, do I acquiesce to the radical Republicans and then shut down the government and then get to a point where the Democrats just say, look, we're not going to deal. I mean, the odds of what the Republicans, some of those conservative Republicans are wanting are less than a 2% chance of ever going to become law. And that's being grateful. So Speaker McCarthy's choice here is essentially saying, look, do I go through the motions of a government shutdown and then do I deal with the Democrats, or do I deal with the Democrats now and get it over with? Ultimately, this is ending with a deal with the Democrats. And so I think from the Speaker's perspective, really what he has to do here is he has to do this deal, but he has to do it in a way that saves him face. Look, he's got to be showing that he's fighting for his ideals and so forth like that. And that's why I think he's going to accept a government shutdown. If he makes a deal before then, I think there were those people that are seeking to oust him get a little bit more ammunition saying, look, he didn't even fight, so let's just kick him out. So I think the Speaker's just playing a little bit of what if scenario analysis here. But I think he's just going to say, look, we got to do this after sometime next week after the shutdown.
By the way, do we call them conservatives? Because they don't really act like that, do we? The Freedom Club people, Nathan, I mean, they're not exactly acting like Ronald Reagan or George H.W. Bush. It's more like, I don't know what word you use. How do you describe, other than, radical populists?
Well, I could say somebody is a conservative Washington, and I'll get 100 different answers of what that means. But, ultimately what's going to happen here is it's the House Freedom Caucus. There's about 15 or so members, maybe as much as 20. But I would also point out that there's also another caucus called the House Problem Solvers Caucus. And one of the things that they're trying to do, and we've heard whispers on this, is that there's about 6 of them. It would take 6 of them to say, look, I'm going to bypass the Speaker. I'm going to work with the Democrats on something called the discharge petition, where I can actually overrule the Speaker. We'll have the Democrats have control of the floor. They'll make the deal. Now, I don't think Speaker McCarthy would be all that upset with it. Look, he could say, look, this is horrible that they're taking my power, so forth like that. But also it's a get out of jail card free for, free get out of jail free card for him. So, I think what the Speaker is doing at this moment is just saying, look, I've got these people over here that want this. This is never going to happen. I got over here this idea of working with the Democrats, which I know eventually will happen, but I just can't go out there and say I'm ready to do it just yet. So unfortunately, it's the people that are going to be stuck. The American people are going to suffer a little bit because of this.
I mean, this seems from I don't know anything about politics and political calculus, but this seems like a disaster for the Republican Party. How is the leadership allowing? A, is it a disaster? And B, how would the leadership of the Republican Party allow this to happen?
Well, it's not like they can come out and just wave their wand and say, do as I say. I mean, the Speaker McCarthy is,
why not? I thought that's why we have whips and majority leaders and things like that.
If the party has fallen apart, if they've lost their minds, then
all right.
But
I'm not saying
also
they have, but then you can't control them, right? I mean,
but if they also make a deal within the next 2 weeks or so, we won't be talking about this come January. We'll be talking about, the presidential election cycle and so forth. So, there are people out there that say, look, shutdowns will be negative for the party that caused it. In this case, it would be the Republicans. But the independent voters' mindset is sort of short term. And per your inflation talk prior to this segment, inflation may be around in January, and that may be the big ticket. So there are some saying, look, shutdowns are bad, but how much of a political price we're going to have to pay? Maybe not so much.
It's a good point. It's a good point. But Nathan, let me get your take, speaking of inflation, on the UAW. And President Biden going there, which I think is, such an exciting story because I love the car makers, and now you've got these 150,000 workers that are potentially going to make a lot more money. It's inflationary. President Biden says he's pro-union, but he's also super pro-green transition and EVs, which the union feels is in some ways is like their enemy. How do you look at that whole situation? Does he have the vitality to go and stand on a picket line? I'm just asking that
for me, this is all about Michigan. He needs Michigan to win re-election, and going to that picket line is just a way to say that, look, Michigan is one of those 5 or 6 states that I need. Going there is just to make sure that President Trump doesn't steal the press cycle by him going there. So, the actions of President Biden actually walking the picket line and so forth like that, this was a political call. I'm not sure how much it impacts, I haven't looked at the impact of how it would impact the UAW negotiations, but this was an easy call for him to make, because if he doesn't go there, President Trump was going to go there, other Republican candidates would go there, and one of your key states would be, you wouldn't actually be in one of those key states that you need.
It'll be tough, though, if some of the workers on the picket line say, hey, Joe, what's with the billions of dollars in subsidies for electric vehicle transitions?
Absolutely. He's going to have a tough time talking to this, but, President Biden also claims to be the most pro-union president ever, Scranton, Pennsylvania. This is something, so I wouldn't put it past him to be able to rely on some of the institutional knowledge he's had over those 70 years to try and go forth and, at least get some talking points out of there. So I don't think it's going to be that much impactful in the way of the negotiations, but again, it's a symbolic gesture that he needs to ensure that he wins the Rust Belt come 2024, because that and Arizona and Nevada are going to be pretty much all the states that matter going into this election.
So is the expectation in D.C., we're getting off the topic a little bit, it's going to be Biden for the Democratic Party? Is there any credible discussion otherwise?
No. Look, we're 3 months away from a primary process, and if President Biden were to stand up and say, look, I'm not going to run for president, who would take his place? Obviously, you have Vice President Kamala Harris, but, Vice President Harris was the first one to bow out in the in the prior election. That person doesn't automatically get the party's mantle. So if President Biden were to say today, I'm not running, you would kick off a chaotic process in which the Democrats would be completely disjointed, and there'd be a really fast-paced fight to try and see who can win. Governor Newsom, probably Governor Pritzker from Illinois, for example, it would just be very chaotic. So I really don't see President Biden saying that he's done. I think he's in this for the long haul.
All right, Nathan, thanks so much for joining us. We can go a million ways with you. You've always got everything on topic. Nathan Dean, Senior Policy Analyst for the U.S. government for Bloomberg Intelligence. He's based down in Washington, D.C., and he is our go-to guy. So there's a lot of balls in the air down in D.C. Most notably, is this government going to shut down? And it looks like, it appears at this stage at least, that the answer is probably yes. And I guess the question now becomes for how long? Yeah, exactly. So we'll stay on top of that. This is Bloomberg. Let's get some company news right now with Lisa Mateo.
Good morning, Paul. Amazon will invest as much as $4 billion in startup Anthropic. Bloomberg's Alex Webb says it's a chance for the e-commerce giant to become a major player in generative AI.
Amazon has very much been seen as a laggard in this space. Google obviously got strong AI chops. Google Bard is their forward-facing chat model. They also have Microsoft as the big competitor in cloud. They are very close to OpenAI, so they have got first dibs on a bunch of generative AI stuff. Amazon did not, and so this potentially beefs up their capabilities in that space.
As part of the deal, Anthropic will move most of its software to Amazon Web Services data centers. Shares right now, they're up about 1%. Meta Platforms is making a move to attract younger users. Bloomberg's Steve Podisk has more.
Meta Platforms could release AI chatbots with distinct personalities across its social media apps as soon as this week. The Wall Street Journal says that in addition to driving engagement, the bots also might have the ability to help with coding or other tasks.
Now, Meta Platform shares right now down just a fraction. And U.S. regulators, they're cracking down on Wall Street's failure to keep records. The Securities and Exchange Commission has reportedly collected thousands of staff's private messages from more than a dozen major investment companies in a WhatsApp probe. Reuters says that it's taking place at firms including Blackstone, Apollo Global Management, and Carlyle Group. Companies and the SAC did not comment on that. Those are the company stories we're following this hour. I'm Lisa Mateo, and this is Bloomberg.
Headlines and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash, being brought to you by Commonwealth, supporting more than 2,000 independent financial advisors with the solutions they need to grow a thriving business. Commonwealth, go where you grow. Visit Commonwealth.com to learn more. Major stock averages lower right now, but they paired some of the earlier losses. The tone has been set by yields and the idea of higher rates for longer as more Fed officials beat that drum. You have 7 of the 11 major industry groups in the S&P 500 were lower. Best performers were energy and consumer discretionary stocks. Amazon, the biggest individual gainer in the NASDAQ 100, as you heard Lisa say, it makes its foray into generative artificial intelligence. S&P 500 right now 5 points lower. That's down 0.8%. We're at 43.14 on the index. The Dow Jones Industrial Average 112 points lower. That's down 0.3%. The NASDAQ 100 right now is 26 points lower. That's down 0.2%. The 10-year yield 9 basis points higher. We're at 4.52. The 2-year pretty steady right now at 5.11. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Matt and Paul.
John Tucker, thank you so much. We appreciate that. Matt Miller, Paul Sweeney live here in the Bloomberg Interactive Broker Studio. Also streaming live on YouTube, so go over there and check us out. Search Bloomberg Radio. You know, Matt, you might remember 2 or 3 months ago, I took that whole recession talk off the table for me. But you know what? With this Federal Reserve higher for longer, I don't know. I think they might run the risk of pushing us into something that we don't really need. So I'm going to talk to and ask a professional about this. Lydia Bussour, senior economist at EY Parthenon. So Lydia, was I a little bit early in taking the recession talk off the table? Is this Federal Reserve with its new, or not new, but continued effort to keep rates higher for longer, are they bringing that recession talk back to the forefront?
Hi, thanks for having me. I mean, the higher for longer interest rate paradigm that the Federal Reserve strongly signaled after the meeting, and with this new dot plot showing interest rates remaining above 5% throughout next year, means that we're going to be in that higher interest rate environment for longer, higher cost of capital, and that's going to be weighing on spending decisions for consumers and businesses. I think this is going to be an additional headwind for the economy. This has already been impacting the economy, but we do believe that there remains a pathway for a soft landing. I think it's important to keep in mind that these higher for longer interest rates are also a reflection of a more resilient and stronger economy, and also expectations for that strength to continue moving forward.
Well, first of all, Lydia, we just got a red hot sticky headline crossing the terminal, and on China and the property issue there. So Evergrande unit missed payment on 4 billion yuan onshore bond. We've all been watching the Chinese property sector again lately, right? It looks worse than feared previously, and the short-lived boost it got from the Chinese sort of stimulus activities is gone now. Is it possible that this spreads around the world, or is it contained to the Chinese economy, you think?
I mean, we believe that China's economic slowdown has emerged as a top risk for the global economy. When we look at the U.S. in particular, when you purely looked at the trade linkages and financial linkages, they're fairly limited in terms of the U.S. exposure, and looking at U.S. exports to China. But when you think about the impact on financial conditions and how that could potentially lead to a China growth scare, the way we saw back in 2015, 2016, that could have an impact on confidence, and that could have an impact on a more significant impact on the U.S. economy. Now, looking at the broader global economy, this is going to have some ramification for economies that are more exposed, and this is potentially leading also to a sharper economic slowdown globally. So
not the U.S., right, Lydia? When you say economies that are more exposed, I guess you're talking more about Europe than America.
Europe is more exposed, but as I mentioned, the U.S., the exposure is really more through financial conditions and a potential deeper global slowdown as some of the other trade partners for the U.S. get impacted as well.
Lydia, back here in the U.S., one of the real points of resilience in this economy has been the labor market, and a lot of folks are kind of confused about why this labor market is so strong, given the inflation out there, given the higher rates. How do you view and how do you explain the labor market to everyone?
Yeah, I mean, we've seen some persistent tightness in the labor market and those lingering labor shortages in some sectors. So a lot of that tightness that we have seen is really tied to some of these post-pandemic labor market dynamics. We've seen a lot of dislocations during the pandemic. And so what we're seeing today is companies essentially holding on to their workforce, their talent, that they really had a hard time attracting and retaining over the past 2 years. So we are seeing some labor hoarding, and that is one of the reasons why, even though you're seeing that rebalancing, even though you're seeing labor demand coming down, we haven't seen that a significant rise in layoff that you would expect in this environment of higher interest rates.
In terms of the path to a soft landing, with all the risks that you mentioned, Lydia, and we've been listing them here on Bloomberg Radio as well, from increased credit card debt to delinquencies on those cards and on auto loans, the return of student loan payments, higher oil and higher gas prices at the pump. What am I missing, Paul?
No, those are all good.
I mean, it seems like the strike, the UAW strike lasting a long time and expanding is a risk. I don't know if the government shutdown is a financial risk or if it's just an amazing annoyance. But all of these things are bad, right? So where do you see a soft landing coming out of that?
Yeah, I mean, all these headwinds, the headwinds you mentioned, are really combining and will combine to slow down the economy. So we do expect to see a downshift in economic activity as we head into 2024. We think that growth will fall below potential, and then we're expecting a number of quarters where growth is going to be fairly modest as a result of some of the old headwinds, higher interest rates, tighter credit conditions, and still high inflation. And some of these new headwinds that you mentioned that are going to be waiting on growth in the fourth quarter. What's important to keep in mind with the strike, with the potential government shutdown, is some of the impact is going to be reversed in the first quarter of next year. So this is also something that I think is important to keep in mind when you think about the outlook. But certainly a nuanced outlook with a resilient economy, but some headwinds that are going to be waiting on private sector activity.
So, Lydia, we've seen inflation come down from the peak of 18 months ago, roughly. But now maybe the hard work starts, as a lot of economists are suggesting. How do you see inflation moving over the next 6 to 12 months?
Yeah, we are in the camp that maybe the last inflation mile won't be as strenuous as some people think. There is a lot of ground to cover in terms of bringing inflation back to target, but we still think that there is a disinflationary environment that remains in place. When you look further ahead at the next few months and going into 2024, when you look at core inflation, we are expecting to see more disinflation on the core side, with housing inflation having turned the corner, with the labor market loosening as well, and also with the fact that we're going to see a slowdown in demand and in economic activity, and that will put further downward pressure on inflation. So we think that we're going to see continued disinflation, and looking at core and headline inflation, it will still take some time, but by the end of next year, we may have gotten closer to the 2% target on both headline and core.
Lydia, how concerned are you about the European economies over there? I mean, we talked about it earlier, but boy, their exposure to China and it just compounds some problems over there. What's your forecast for just Europe and the UK going forward?
Yeah, we are seeing more weakness for the European economy, and we are seeing more headwinds as well from the China slowdown. When we look at economic activity, we are seeing some economic indicators pointing to a further downshift. And now the outlook is, not the same for each individual country within the Eurozone. We are seeing localized weakness in Germany with this recessionary conditions in Germany. The UK is also showing more signs of weakness, but overall, this is a region where we are expecting to see more weakness this year, and this is going to be a soft spot for the global economy, along with the Chinese economy.
Lydia, thank you so much for joining us. Always appreciate getting your comments. Lydia Boussour, senior economist at EY Parthenon. All right, Matt, I got to circle back. I was aware, John Tucker and I were just trying to keep track. We've got the Challenger with the Scat Pack. It's been made. It's en route.
Yes, the wide body package. Don't forget that, because it's a key part of the car.
Of course it is. But now you just mentioned a motorcycle?
I've got a new Indian coming.
Where are you putting all this stuff?
This is the thing. I need to build an addition to the house. I just broached the subject with my wife over the weekend.
How'd that go?
In addition to the garage.
Yes, I need to build more garage, a couple more garages, frankly. And
now I should point out, in the suburbs, especially Westchester County, Paul, nobody uses a garage to house their cars, their vehicles.
Exactly.
It's all the extra
well,
stuff.
we have this, so it always annoys my wife that people come in the back door. She wants them to go around the front, but there's no way, the way our house is set up. So I told her, listen, if we can block the back door with an extra garage.
Oh, perfect.
And then they'll have no choice.
All right, so we got the Dodge Challenger with the Scat Pack wide body thing coming. We got a Indian Motors. I don't know what else. So John Tucker and I, we'll stay on top of it. Right now,
Indian Chief.
Indian Chief, of course. Why not? Right now, let's head down to Washington, D.C. Amy Marsh has got world and national news.
All right, thank you, Paul. We're closely following the developments on Capitol Hill with a potential government shutdown by the end of this week. House Speaker Kevin McCarthy has been trying to rally the hardline members of his own party to pass a stopgap spending measure, but he's still facing pushback. And Greg Valliere is Chief U.S. Policy Strategist at AGF Investments.
It's probably about 75% that we will get a shutdown this weekend. Kevin McCarthy can be shrewd sometimes, and he might be able to come up with a last-minute extension of a month or so, but I doubt it. I don't think he has the votes, and I do think there will be a shutdown.
Greg Vallier at AGF Investments. And the federal government's current funding is set to run out this Saturday. A shutdown would also come one day before drug makers selected for Medicare pricing negotiations are supposed to provide the agency with data required as part of the program, and likely throwing off the timeline for the program. There's been a surge of undocumented migrants crossing the southern U.S. border, thousands each day. Texas Republican Congressman Tony Gonzalez says it's time for Congress to take action.
The House should immediately take up the Homeland Appropriations bill. Republicans can't just be the party of rhetoric. We have to be the party of solutions.
He tells CBS's Face the Nation he wants to get a bill on the House floor speeding up the work visa process. Maui residents are being allowed back to their properties in Lahaina nearly 7 weeks after their neighborhood was mostly destroyed by a wildfire.
A lot of us have not actually been able to come back. To see someone go in an unexpected way, it kind of hurts.
At least 97 people died in that fire. Global news 24 hours a day. Powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Amy Morris. This is Bloomberg.
Profits, headlines and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. Major averages right now on track for back-to-back monthly losses. Investors continue to fret over rising bond yields and indications the Fed plans to hold interest rates at high levels for an extended stretch. A 10-year Treasury yield, multi-year highs, that's up 9 basis points. We're at 452. Toss another wrinkle into the appetite for risk. In China, the property developer Evergrande missing a debt payment. It could be a rocky road ahead for investors, according to Katie Kaminsky at Alpha Simplex.
The market has really finally said, wait a minute, upside risks are real. Like higher energy prices, that's a challenge. I mean, these things have to be solved for the equity market to waver through this.
And Fed speak, President of the Chicago Fed, Austin Goolsbee, says there's still reason to believe the economy can skirt a recession. He's pointed to low unemployment. S&P 500 right now 4 points lower. That's down to 0.1%, 43.15 on the index. The Dow Jones Industrial Average down about 120 points. That's a decline of 0.4%. And the NASDAQ 100 21 points lower, down 0.2%. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Matt and Paul.
Hey, John Tucker, thank you so much. We appreciate that. Matt Miller, Paul Sweeney live here in our Bloomberg Interactive Broker Studio. We're also doing a streaming thing on YouTube. So head over to that internet thing, youtube.com, and search Bloomberg Radio. All right. Matt Miller and I have been telling you for as long as we've been doing this that we love the private credit business. I mean, that seems where all the capital's flowing. That seems where you can get some serious return. And if I were starting,
and the deals are getting bigger and bigger. I think we just saw a $5 billion deal, and
a week or two ago, right?
Blue Owl, says they think. I was talking to one of the guys from Blue Owl. He said 10 billion is almost a foregone conclusion.
Yeah. So we all know about private equity. Now we know about private credit. Jess Larson joins us. He's the CEO and founder of Briarcliff Credit Partners. He joins us live here in our Bloomberg Interactive Broker Studio. Jess, you guys just focus on this exclusively. Matt and I, we know private credit as like direct lending, but you're telling us it's more than that, right?
That is such a good question, right? And private credit means a lot of things to a lot of people. And there's a little bit of a misunderstanding that direct lending is all the rage of private credit. Direct lending is a great sub-strategy within private credit, but private credit is really a lot more. So what we have identified is 4 pillars of private credit. You've got corporate credit, structured credit, real asset, and specialty finance. Underneath that, 26 different strategies.
Oh boy.
It doesn't matter where in the economic cycle we are, there's always strategies for you to make money. And that's exciting about private credit, right?
And private credit seems to me to come out of nowhere over the last 4 or 5 years.
Well, yeah.
Right?
I mean, I've been going to the Super Return Conference for the past, 7 or 8 years in Berlin, which was a private equity conference, right? But more and more of the people there are just talking about private credit, and a lot of the big shops that you think of as PE shops are actually, the majority of their investments are on the credit side now.
Absolutely. I mean, the big firms are pivoting from PE to private credit, right? What we're seeing right now is we are in the golden age of private credit. What we will see in 10 years, if I can be so bold, is in 10 years, private credit is going to be bigger than private equity.
Wow.
This is our age, right? And I have to say, Matt, Berlin is great. But next year, come to our summit. We had it last week. Over 100 LPs came to hear just about private credit. This is really a super
Where is
exciting.
it? Because the city is important to me.
We did it here in the Metropolitan Club. We made it easy for you.
I thought you were going to say I could go to Copenhagen, which I would like to do.
That's where I'm from, but you're more than welcome. We can do that as well.
It's easier for us to take a subway to
That's true. Yeah, we can walk to the Metropolitan Club.
We can do that as well.
We can do that.
Jess, talk to us about how this industry came about. Is it just simply the regulators put the traditional big banks out of this business?
It is a really good question, right? Because if we think about private credit, this is not a new thing. People have been lending to each other since the start of humankind, right? Mm-hmm. So you go back to Plato and those times, the Medici family, it was all about lending. Now, we called it usury at the time, but it was all about lending, right? So lending and private credit has been around since the early times. Now, you're right, during the GFC, we got the regulatory environment really supporting getting the credit out of the banks, because it's not the right place for lending to mid-market companies, and get it into the private credit space. So that was really the catalyst of what I would call the golden age of private credit.
Yeah, the Germans would have a problem with that, right? Because that's their bread and butter of German banking. And I think, there's no sort of Mittelstand credit here the way there is on the other side of the Atlantic. But we would call that shadow banking. Is that a dirty term?
I think private credit sounds a lot better than shadow banking, Matt. Come on.
So it is, though, because you're pushing it out of the regulated banking sector and into more of a, I don't want to say Wild West, because we talk to private credit men and women here all the time who are obviously very responsible, learned individuals, used to dealing with sophisticated investors, but you do have less regulation.
You do have less regulations. I would be contrarian and say we're pushing it out to where it belongs. Mid-market lending does not necessarily belong in a bank. We saw the risk you're taking on. If you're a mid-market company and you want to borrow some money, doing it with a bank adds a whole other layer of risk, right? We saw that with Silicon Valley Bank. We saw that with Credit Suisse and Signature Bank and so forth. Now, the private credit funds are set up and have a much better asset liability match. So this is a much better place for our mid-market. The economy needs it, right? The economy cannot survive without mid-market lending. So we need it, but we just need it to have it in a better place. And that's where we're going.
All right, mid-market lending. Do you envision the day when you characterize your industry as something more than mid-market lending? Not that that's not a great business, great returns, but bigger deals, bigger tickets. Is that where we're going?
That's also where we're going. I think you're 100% right, Paul. This market, in terms of private credit, is going to go from mid-market to upper market to where we need to be, right? Simply because it makes sense for the borrowers. If not, we wouldn't have it.
What about the lenders? I mean, right now, or previously, it was big institutional money, as I said, sophisticated investors, so people who, could afford to take losses. We've had people on the program that are looking to start platforms that allow retail money in. Mm-hmm. Is everybody going to get involved?
It's coming, right? We all need to be careful when there's retail money, right? There is a higher level of scrutiny, the higher level of regulatory environment when it comes to retail money. I think we started the right place with the big institutional money or capital coming from the pension funds, endowments, foundations, the big family office. We started with that money. We're slowly moving into the retail, but it does require a little bit more of a regulatory overview.
So what's a typical deal that Briarcliff invests in?
So we actually don't invest, Paul. Okay. What we really do is we take the smart funds and actually bring them out to the institutional investors.
You're a placement firm.
We're basically a placement,
gotcha,
yeah.
okay.
And we're the only one in private credit, believe it or not.
So you're the only one.
We're the only placement in the world that is completely
He wants to hear the numbers. All Paul cares about in life is making money.
I love it. So there's 3,000 placements globally.
Okay.
There's only one that is dedicated to private credit. It happens to be in your studio right now.
So what are the deals look like? I mean, especially as in this rising rate environment. On the one hand, I think it's going to get juicy. Mm-hmm. On the other hand, I may be worried about companies that have to refinance or companies that have been lent to at much lower levels.
Yeah. I think it is a worry or it's an opportunity, which way you want to look at it. Because as we mentioned earlier, private credit is more than just direct lending, right? So there are special sits, there are distress managers out there. There are all sorts of strategies that can capitalize if the default rate starts to spike. Let's see if it happens. But if we are going to get more losses, there are credit funds out there that can actually capitalize and go in and save these companies. And that's what we need. Where the banks would shy away, right?
Right, but because private lenders work more closely with management of the portfolio companies.
Yeah. Thank you for the pitch.
Well, I think we need to be skeptical as well. That's our job, right? Yeah. And I wonder what you do when regulation does come knocking, because there's going to be a day, when some senator gets a craw in her bonnet or whatever and decides you're the problem.
Yeah. Well, the question is whether it's a problem, but I don't think regulation is necessarily a bad thing, right? What we're doing right now is moving it out of the banking system to the private credit system where it is better placed. That's the first step. The next step is probably getting a little bit more oversight. And we are already seeing the regulatory environment starting to looking at valuation, reporting, and so forth. So it's coming, and it's a good thing because it gives everybody a little bit more comfort.
Gotcha. All right, Jess, thanks so much for joining us. Jess Larson, CEO and founder of Briarcliff Credit Partners, talking about private credit. This is Bloomberg. Let's get some company news right now with Lisa Mateo.
You got it, Paul. UBS CEO Sergio Modi is making his first trip to China since the company took over Credit Suisse. In an exclusive interview with Bloomberg, Modi talked about the firm's commitment to clients in China.
This is my first trip to Asia since taking on again my role at UBS, and I think it's very important for me to reach out to all the Chinese stakeholders and reiterate our commitment to China while also updating them on the integration.
Now you can hear the full conversation on the Bloomberg Talks podcast. Download it wherever you get your podcasts. Checking with UBS shares right now, they're down almost 1%. Apple's cheapest iPhone is a hit with buyers, but they're gonna have to wait for it. Bloomberg's Courtney Donahoe explains.
It's taking almost twice as long to get your hands on a basic Apple iPhone 15 model compared to when the 14 was launched. According to Counterpoint Research, buyers are waiting 10 days for the phone, up from 6 days for the predecessor last year. And it takes 48 days to receive a top-tier Pro Max.
Now, even in China, Apple's biggest overseas market, wait time for the basic version quadrupled from last year. Now, as for the 15 Plus and 15 Pro, they've not been as popular. Shares of Apple right now up just a fraction. And meanwhile, Apple plans to increase production in India more than fivefold within the next 5 years. Government offices, they tell PTI the tech giant surpassed $7 billion production in the company in the last financial year, and it's aiming for $40 billion. No comment yet from Apple. Those are the company stories we're following this hour. I'm Lisa Mateo. This is Bloomberg.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
All right, Matt Miller and Paul Sweeney live here in the Bloomberg Interactive Broker Studio. Looking at these markets, red on the screen as John's been reporting. S&P off 0.2%, the NASDAQ off about the same here. Looking at yields, that's kind of where the action is here today. We got the 10-year Treasury up 8 basis points, 4.52%. I'll round up a little bit there, so that gets your attention. The 2-year actually flat, 5.1%, so we got a little bit of that yield curve, kind of reversing that inversion, if you will. Right now, let's head down to Washington, D.C. We'll get world and national news with Amy Marsh.
All right, thank you, Paul. House Republicans are planning a week of votes on massive spending cuts as Republican leaders try to persuade hardline conservatives to support a stopgap measure to avoid a government shutdown. Leaders are considering one funding bill that would run somewhere between 14 and 60 days just to buy them a little time and would cut domestic spending by 27%. House members prepared more appropriations bills and cuts in a Rules Committee meeting over the weekend. Now, Republican frontrunner and former President Donald Trump is set to be in Michigan on Wednesday, hosting an event in suburban Detroit with striking auto workers and other union members. Now, the timing on this is interesting. It's a day after President Biden visits striking auto workers and the same day as the second GOP presidential debate in California. Greg Valliere is chief U.S. policy strategist at AGF Investments and says the debate will still be one to watch even without the former president.
Wednesday night's debate is really important among the Republicans. If Ron DeSantis doesn't show some spunk, I think he's out. I think that 2 or 3 candidates could be out, and we begin the process of winnowing down the field.
Greg Valliere at AGF Investments and the chair of the Republican National Committee hopes former President Trump will take part in at least one of the 2024 presidential debates. Ronna McDaniel tells Fox News Sunday she has urged the former president to appear at a debate before primary voting begins in January.
Oh, I want him to attend a debate, and he knows that. Everybody knows. I think the other candidates also want him to attend a debate.
Trump says he doesn't see the need to participate in the debates as long as he has such a strong following in the polls. Costco is pushing deeper into the medical marketplace, offering members access to medical care through online marketplace Sesame, where clinicians get their prices set and patients pay them directly, no insurance. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Amy Morris, and this is Bloomberg. Matt and Paul.
Amy Marsh, thank you so much. We appreciate it. All right, Matt, you type in MSFT, the ticker for Microsoft, hit equity, then you go ANR for analyst recommendations. 54 buys, 7 holds, and 0 sells. But as of Friday, there was 1 sell rating, but that analyst has now upgraded the stock. So Microsoft lost its only sell rating on Monday as Guggenheim upgraded its view on the software giant to neutral, citing a tailwind from generative artificial intelligence. Quote, like every other person on the planet, we've come to expect that the Gen AI narrative will become more than just a story, though we still question how much monetization will be realized and over what time frame, wrote analyst John DiFucci. He was the only sell rating on Microsoft, but he's biting the dust and kind of joining the crowd with everybody else, and probably not a bad move. The stock's up 31% year to date. It's up 33%.
I don't recall ever having seen a stock with this many buy ratings and 0 sell ratings. Yeah. I mean, maybe my memory, my short-term memory is problematic.
Actually,
clearly,
it happens a lot. So it's kind of
54 buy ratings and 0 sell ratings.
Yeah.
What other stock
the question
has
is,
that?
why are there 60 analysts covering stock? Does that 60th analyst really add any value, incremental value? So that kind of goes to, I would argue, the economics of the sell-side research model. Like,
Apple has got 4 sells.
Does it?
35 buys, 13 holds, and 4 sells.
Yeah.
Also, I feel like hold is kind of a polite sell, isn't it?
Yes.
Why not just come out and say buy?
Right. You're either buying them or you're selling them.
Yeah.
My sales manager, Payne Weber, would say, Sweeney, are we buying them today or are we selling them? Just tell me. I got to write some tickets. That's kind of how he always said it. He could care less from my analysis. He just wanted to know, like, how am I going to make money on your call today? Am I buying them or am I selling them? But Microsoft, it seems like everybody's got buys on that name, and why not? It's Microsoft. We'll have more coming up. This is Bloomberg.
This is Bloomberg Markets with Paul Sweeney and Matt Miller.
We got a lot of green on the screen here, but the volume is light.
We constantly underestimate the strength of the U.S. consumer.
This is a market that's much more optimistic or bullish than maybe the central bankers are.
Breaking market news and insight from Bloomberg experts.
There's still some concern out there in the market that there is room for things to deteriorate a little bit more than what they're indicating.
As small and medium-sized businesses struggle, they don't present as much competition.
The supply chain has still got dislocations globally and here in the U.S.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
All right, coming up in this hour, we're going to check in with RJ Gallo, Senior Portfolio Manager at Federated Hermes, talk about the bond market. And then we want to touch base with Anurag Rana. He's a Senior Tech Analyst with Bloomberg News. I want to figure out what Amazon is doing here with their acquisition of AI startup Anthropic. And then ETFs. Who doesn't want to talk about ETFs? That's where all the money is going. Patrick Ryan, president of Madison's Funds and ETFs, joins to talk about ETF flows, how much money is coming in, and where is it going. We'll get to all of that coming up. But first, let's check in with John Tucker on the Bloomberg.
All right, let's start with the Treasuries. The 10-year yield climbing nearly 8 basis points right now to a high of 451. The higher yields for longer. That is the theme driving markets. Last week, we saw the worst weekly sell-off on Wall Street since March. It is risk-off, but the major stock averages, they have paired some of the earlier losses. Earl Davis at BMO Asset Management believes higher yields will cause these markets to unravel.
So we do believe we unravel because you have to reprice for the higher discount rate. Once it does unravel, we will be buying. We will be going overweight. And I think that's something important to note, that, these are the flows and ebbs of the market, and it presents itself with opportunity. That's why, we're active managers, and that's what we believe active managers should do.
Among the individual movers, you have Netflix rising, leading film and TV producers higher after the screenwriters reached a tentative labor agreement. By contrast, you have Foot Locker, Nike, they're sliding. Jefferies analysts downgrading those stocks over looming consumer headwinds. Right now, the S&P 500, 10 points lower. That's down 0.3%, 4309 on the index. The Dow Jones Industrial Average, 177 points lower. NASDAQ 100 down about 40 points. That's a decline of 0.3%. Lego dropping plans to use recycled plastic bottles to make new building blocks. This is the world's largest toy maker. I don't think I knew that. It says it requires too much new production equipment. Lego has a goal to reach net zero emissions in 2050. So why do I think
2050? Why do people make goals out so far?
This is like, why bother?
I mean, yeah, exactly. 27 years from now, they're going to become net zero?
I'm doing the math. Am I going to 8? Oh, boy, I'll be 86. That's grim.
Yeah.
Oh, that's depressing.
I'll be 77.
I feel there's a lot of trips to Legoland in your future, Matthew.
My daughter will be a PhD, and she's 2.
Legos. Where is Lego?
They're Danish, right?
Danish?
Yeah, one of the Benelux countries. I don't remember. Not from around here.
I'm pretty sure they're from Denmark. I'm pretty sure.
Not from Jersey. Okay.
But my daughter I've already stepped on a Lego, if that's where you're asking. Yes.
That is really painful because we get up in the middle of the night, and I can't tell you the number of times that going out the door to Bloomberg LP, parent company of Bloomberg Radio, I have stepped on a Lego in the middle of the night. And
Who
man,
hasn't?
that hurts.
Who hasn't? It's a badge. Every parent has. John Tucker, thank you so much. We appreciate it. Matt Miller, Paul Sweeney, live here in our Bloomberg Interactive Broker Studio, streaming live on that YouTube thing. So head over to youtube.com and search Bloomberg Radio. Alex Semenova joins us. She covers all the equity markets for us. She joins us live here in studio. Alex, what are you looking at today?
Hey guys, great to be here with you as always. I'm looking at film stocks. It's kind of a mixed picture. You got shares of Netflix up, but Paramount and Walt Disney down. And those moves come as Hollywood writers and studios reach a tentative labor agreement settling one of 2 strikes that have shut down film and TV production. This agreement comes after 5 straight days of negotiations between the Writers Guild of America and the CEOs of companies including Walt Disney, Netflix, and NBC. Now, if approved by the Guild, this agreement will put an end to the strike that began on May 2nd. Neither side really released many details about the discussions, but the Wall Street Journal did report that the agreement includes increased royalties for writers, minimum staffing requirements for writers, and protections against the use of artificial intelligence. In earnings reports in recent weeks, the studio said that the strike was actually saving them money in the near term, but would cost them in the long term as they have less content to put out. So
the stocks aren't moving because this isn't even an issue. I mean, the big issue is, can they even make money in this new streaming business world? That's kind of the big issue.
And most companies don't, right? I mean, Netflix does
makes
make
a ton,
money.
because they're way ahead of everybody else. And now the question is, how many streaming services will the market support, and what kind of economic returns can you get? And I think what investors have said, I don't know, but they're nowhere near as good as what we've had over the last 30, 40 years. And I'm going to sell my stock now, and I'll come think about it later.
I mean, Netflix makes looks like basically $4 or $5 billion a year, maybe 6 or 7 over the next couple of years. But everybody else loses money on this business, right?
Yeah, they do. And again, once they scale, it'll get better. But I mean, this is the great thing about owning a media stock for the last 30, 40 years was it's, mid to high single digit revenue growth, 35 to 40% EBITDA margins, 15 to 20% free cash flow margins. Take that to the bank. And that's the business model. That doesn't exist anymore. So now everybody's trying to figure out what is the new business model and what do I pay for it? And again, I've spoken to a lot of investors that I've known for 30 years who say, I just don't know the answer to that, so I sold. And if I ever figure something out, I'll come back to these names. And that's really the problem. So anyway, just a little bit of an expansion on what's happening for those names.
Indeed.
What else you got?
Yeah, so another sector that I'm looking at is consumer stocks. Nike, Foot Locker, and Urban Outfitters are all down today after they got a wave of downgrades from analysts at Jefferies. The firm moved these stocks to a hold rating from a buy rating over concerns of a consumer squeeze. Analysts there said that Nike faces a risk from a slowdown in consumer spending in the U.S., specifically amid the return of student loan repayments in October. That's in addition to ongoing headwinds in China, where sales trends have been quite choppy. And more broadly, Morgan Stanley's Mike Wilson also today warned on consumer spots, which of course have been one of the bright spots this year. They said that they're about to lose
Mike
their
Wilson guy. I mean, I've had enough of this.
He always
we
has
need to get him in
bearish
studio.
narrative.
We got to get him in studio because I'm like, who are you again? And why do Bloomberg News quote
He's
you
gotta be
every
one of the most
single
famous,
day?
He's got to be one of the most noted bears in the entire stock market, right?
Yeah, he seems to have a new bearish narrative every week. Before it was inflation falling is bad for companies. Now he's warning on the consumer.
Well, inflation rising was supposedly good for companies. So inflation falling better be bad for companies.
It's always something new with him. I do got to give him credit, though. At least he was one of the strategists who did say that he was wrong in being bearish for far too long. He's not changing his stance, but a lot of people didn't really admit that they missed out on the rally.
I'll tell you what, the NASDAQ is down 8% since the end of July when it hit, I think, the high for the year. The Russell 2000, did you see that story over the weekend about recession signs? The Russell 2000 is off 11%. The Industrials Index is off 11%. I mean, or 14% from its highs. We've had recession signals coming from rates forever, and now they're starting to come from stocks. And I could pull out my Torsten Slok list of things to be worried about, but I've said it far too often here. There are a lot of headwinds for this economy.
Yep. I'm looking at this reporting from the Nike story. The return of student loan payments in October is seen squeezing consumers in the U.S., with a report by Oxford Economics estimating that this could dent spending by much as $9 billion each month. That sounds big.
Yeah. In aggregate, it sounds horrible. But even if you look at just the individual numbers that I was quoting Mark Zandi on, costs for the average family have risen $734 a month in the last 2 years, even though pay's only risen $211. And if you add another $300 to that, the average family costs have gone up well over $1,000, and they're only making $200 extra bucks.
Yep.
That's, I mean, where I'm from, that's real
squeeze.
money.
That's real money. That's a squeeze.
Yeah.
Okay. Anything else there, Alex?
Yeah, of course, Microsoft is an interesting one today. It lost its only sell rating as Guggenheim upgraded its view on the company to neutral. Analysts there specifically cited tailwinds from artificial intelligence. No surprise there. In their note, they said, like every other person on the planet, we've come to expect that the generative AI narrative will become more than just a story, though we still question how much monetization will be realized and over what time frame. The firm still did cite struggles with Microsoft's Windows product, calling it one of the troubling dynamics weighing on the stock, along with growing pains in its cloud business. This move broadly, though, reinforces the positive consensus on Microsoft. You guys were talking about it earlier. According to Bloomberg data, 90% of analysts currently have buy ratings on the stock, while the rest have an equivalent of a hold rating.
Boom. That's consensus for you. All right, Alex, thank you so much. We appreciate that. Alex Semenova, she's a Bloomberg equities reporter, giving us the latest on this market. Let's switch gears to the bond market. RJ Gallo, senior portfolio manager at Federated Hermes, joins us here. RJ, it's been, we started in the fixed income business this year with some nice gains. We've kind of given them pretty much all back here. What's your positioning here? What's your call here on the fixed income space?
Good morning. It's been painful. We started the year pretty optimistic that fixed income is going to post more attractive returns. Call it non-negative, low single digits. We felt that the cumulative impact of the drastic Fed tightening would ultimately produce a slower economic outcome than has actually been realized. The U.S. economy has been very resilient. Fiscal policy and households are the reason. The question now, as we have seen a lot of the gains in fixed income on a year-to-date basis turn into losses, the question now is, will the consumer finally fade? Our view internally, and admittedly the confidence is a little low because it's been surprising to the upside, is the answer to that question is yes. I think you were just touching on the resumption of student loan payments. The excess savings that were accumulated through various COVID relief bills is getting close to being exhausted. The cost of living has gone up. Look what's happening to energy prices most recently. We think mid and lower income households are finally going to fade after what was really a spend-happy summer. And that's about to help to relieve some of the upward pressure on yields going forward. So we're still leaning a little bit long, but admittedly, we've been somewhat humbled by the dynamic so far.
So, what do you expect this Federal Reserve to do here? I mean, it feels like, judging by, the most recent commentary, that they're comfortable right here. And in fact, maybe even may take rates up one more time.
Yeah, well, 12 of the 19 Federal Reserve members said they're going to. And by the way, that dot plot is, it's not a jawboning plot. That's their actual forecast for where they think rates are going to go. So, I mean, RJ, this market hasn't believed a thing the Fed has said for the last 2 years. Do they finally buy it on the one more hike?
The dot plot's a projection, not a promise, and they're written in pencil. They move a lot. I do feel that the Fed finds them to be very powerful tools to enhance their communication. You can actually give a level where you think rates will be at a point in time. That's a pretty strong tool for the communication side of the FOMC's objective to guide and interact with markets.
But RJ, 12 members of the Fed think rates are going to be one hike higher by the end of the year. And by the way, we're almost there. So it's not like they're forecasting out to 2030. They're forecasting out to like next month.
Well, they forecast out, the current forecast goes out to 2026. At the end of each year, as you get near the end of each year, they go out a little further. And they give you that long run dot as well. That long run dot doesn't get a lot of discussion. And I think maybe it should in the current environment. The post-pandemic economy has been more inflationary, more resilient, and more debt-laden in terms of more and more sovereign debt issuance. Also, we've had a lot of talk and expectation that productivity is going to benefit from AI and greater technological progress going forward than it has in the recent past. All of the above should boost equilibrium real yields and equilibrium nominal yields, which the long-run dot, in a sense, is the Fed's policymakers' best guess, best projection of what is the equilibrium long-run Fed funds rate. And that has an impact all across the yield curve. I wouldn't be surprised to see that long-run dot, which has not moved, the median has not moved for quite a long time, start to see that gravitate higher. And I think the markets are struggling with where is the equilibrium level of the yields. the Fed has heightened drastically. The inflation has come down. It's still too high relative to target. The economy is resilient. Where is this all going to end up? And the equilibrium yield concept is a way of sort of tying up that picture. The uncertainty is high. And I think bond investors right now came into the summer long. It was a spend-happy summer. The economy is strong. And I think we're seeing significant pairing of risk as we head into the fall. One interesting thing we haven't touched on, the government shutdown. Significant portions of data that we rely upon as investors to try to ascertain where the economy is, that the Fed also relies upon, that data will not be forthcoming in the month of October if the BLS shuts down. So we're going into a period where we have partial data blindness. We'll still get stuff from private sector data providers, but not from the government. And that's, in and of itself, could have something to do with sort of the rapid repricing that we've seen lately. You think the economy is too strong, but you're not going to know exactly where it is in October. So pare back some risk if you have a long position in this market. I think that's adding a little bit of weakness to the most recent trade.
Interesting. RJ, where do you folks at Fidelity, where do you see opportunity in the fixed income space given that backdrop?
So we have been, as I said, we've been a little offside. We've been neutral to long throughout the year. That has detracted from performance. We've been overweight mortgages. We've liked the up in quality trade in fixed income. That's been a little offside too. I think is the cumulative impact of the Fed's tightening, the impact on households from higher energy prices, from the resumption of student loans, from slowing job growth. All of these factors are apt to benefit the up in quality bond trade. Year to date, that has not been the case. We know credit has won. Both high yield and investment grade have outperformed. We think we're sort of at an inflection point because valuations have gotten pretty tight and the economic fundamentals are eroding as we head into the end of the year. So up in quality, neutral to long duration, and we think the worst is over from the Fed. Matt was touching on it earlier. The Fed's pretty much done. One more hike is not all that hard to deal with when you've had how many we had? I mean, 525 basis points of hikes. We're near the end of it. We think value has been restored. The question is, where is that new equilibrium yield level around which we will oscillate in coming years?
RJ, just got 30 seconds left, but I've been wondering this morning, what does it say about your view if you want to move out in duration? If a fixed income fund manager says we want to get out in duration, what does that mean about your view on the economy?
We think the economy is going to be softening for sure. We would argue people who are in money funds are very happy getting north of 5%. We manage hundreds of billions of money funds. We're happy to do that for them. But I think ultimately moving out the curve, taking out some intermediate duration in your portfolio as opposed to money market funds over the next 3-6 months, you're going to be happy with that trade as you look out over the next coming years as the economy does slow and the Fed will be forced to partially reverse some of the tightening they've done if we get a mild recession, or even just to secure the soft landing, which the market seems to think is a good chance that might happen.
All right, RJ, thank you so much for joining us. RJ Gallo, Senior Portfolio Manager at Federated Hermes, talking about this market. Again, looking at the 2-year, it's pretty steady right here, 5.1%, but the 10-year Treasury up 7 basis points, 4.5%. We were at 4.53 a little bit earlier this morning, so rates continuing to move higher. We keep a note on that. A little bit of a pullback on crude oil, off about 0.5% here, or I'm sorry, 0.75% here. WTI crude oil, $89.38 for WTI crude oil. This is Bloomberg. Let's get some company news right now. Lisa Mateo.
Thanks, Paul. Shares of HP are under pressure as billionaire investor Warren Buffett continues to trim his stake. According to the latest SEC filing, he's selling 129 million shares. We have more from Bloomberg's Katie Greifeld.
That sale took place over 3 transactions between the 20th and the 22nd, and it follows Berkshire's earlier sale of about 160 million shares just a week or 2 ago. Now, rewind. Remember that Berkshire began building up this stake in the PC maker last spring, and looking at the filings, it looks like Berkshire may be rethinking that position now.
Now, HP's latest earnings showed revenue drop by nearly 10%, and the company lowered its full-year profit forecast. Shares right now down about 0.7%. A wholesale retailer is pushing deeper into healthcare. Bloomberg's Gina Cervetti has that story.
Costco will offer members access to medical care through a deal with an online healthcare marketplace called Sesame. And Sesame said that Costco's members will be eligible for online primary care visits for as little as $29. The doctors on Sesame set their prices and patients pay them directly, not through insurance.
And shares of Costco right now, they are down just a fraction. And Rite Aid plans to close hundreds of locations. Sources tell the Wall Street Journal the pharmacy chain is negotiating with creditors over a bankruptcy plan that would include liquidating about 400 to 500 of its drugstores. And either